We are doing auditing and assurance block revisions, and I'm your lecturer, John Kabucho. I'm taking you through the topic audit report revisions. So we are going to do the revision of the audit report, but before we do the questions that we are going to be working on, it's good I give you an overview of the whole topic of audit report, exactly what you're supposed to know. Now, this question of audit report is not very difficult. Some students think that is very technical or maybe complicated. Audit report. We say audit report on financial statements. On financial statements. That is the whole topic. But this topic has a number of items that you need to know before you go ahead and do your exam. One, you need to know the definition of certain terms. One of the definition is the term auditor's report. Auditor's report. And the other one will be, the other terminology will be the auditor's opinion. What does that word mean? The other terminology that you need perhaps to note is what we refer to as the word true and fair. True and fair. And once you know that, then the next thing you need to note is what we refer to as the legal framework or the legal provisions on auditor's report. We call them sometimes legal matters or legal requirements on auditor's report. The other part that I believe you can be able to go ahead and be asked is a question of elements. Elements in the auditor's report. So I'm not going to cover them, I'm only going to highlight them. Elements of auditor's report. This one is also a very common question. Report. But the most common question of all is what we refer to as forms of opinion. Forms of opinion. So make sure you can be able to know the forms of opinion that an auditor can express. The other last bit is the implications of the auditor's report, whether it is qualified or unmodified. And maybe they also sometimes ask the features of auditor's report. Features of auditor's report. So I think I can just mention a few briefly, maybe like 5 minutes, that auditor's report is a report of the auditors addressed to the shareholders and members of the company, expressing an auditor's opinion on the financial statement. That's how we just do the definition. That it is it's a report of auditors addressed to the shareholders of the company, expressing the auditor's opinion on the financial statement. The term opinion, we define it as auditor's personal judgment or professional judgment on the financial statement. So when an auditor is making his own conclusion or judgment after examining the financial statement, he comes up with a professional conclusion. We call it an opinion. The term true in auditing means that the financial statements are in accordance with the financial reporting standard. Financial statements are in accordance with financial reporting standard. The term fair means that the auditor has, not the auditor, but the financial statement have been prepared in accordance with the user's expectation, according to the user's expectation. So this one means according to the international standards on international accounting standards. This one means in accordance with the user's expectations. Then there is what we call legal matters or legal requirements. This one mostly are covered by Section 730. If you have gone through the Kenyan Companies Act, or maybe the Companies Act, you will find those particular matters whereby we say an auditor is required to write a report. And once you write a report, you are supposed to go ahead and express a number of matters. For example, an auditor is supposed to state whether he has received all information and explanation. Received information and explanation. That one you're supposed to report in the report. Then you're supposed to tell us whether proper books of accounts have been kept. Proper books. And lastly, you're supposed to tell us whether the books of accounts are in agreement with financial records. Books of accounts are in agreement with financial records. I remember any? I can list a few here, but maybe we can list all because we are doing revision. The first one is called the title. That is number 1. Number 2 is called the addressee. And number 3 is referred to as what? The introductory paragraph. Do you remember number 4? Number 4 is referred to as the management responsibility. Number 5 is known as the auditor's responsibility. Number 6 is known as the auditor's opinion. Number 7 is known as the legal matters. Number 8 is known as all other. This number 7 is also referred to as other reporting responsibilities. Number 8 is known as the signature. Number 9 is supposed to be what? The date of the auditor's report. And number 10 is known as what? The address of the auditor. I hope now you can remember all the 10 what? Elements. Forms of opinions. I hope you remember this word, unqualified, also known as what? Unmodified opinion. And then we have what? The qualified opinion. Qualified opinion are of two types. We have qualified opinion arising from disagreement, and we have qualified opinion arising from limitations. Then we have a disclaimer of opinion arising from limitations of scope, disclaimer of opinion. And the last type, not last, but the second last is called adverse opinion. And lastly, we have a type of an opinion known as emphasis of matter, paragraph. So always remember that paragraphs, or maybe the opinions are 5, emphasis of matter is the last, and emphasis of matter is intended or maybe is issued whenever the author wants to express more about that. So that is just an overview of that particular area. So what I beg to do in this particular case is we pick a number of questions, we work them starting from May 2014. So let's go to May 2014 in our past paper. And then we look on few things relating to that particular topic, and we see maybe how the examiner has framed the question and mode of answering that particular question. Now I'm going to read my question here. If you have yours, you can read with me. If you don't have, then you can listen to this particular question. This question I'm reading here is question 1A in May 2014. In May 2014, the examiner decided that he's going to surprise the student with question number 1. And part A will be auditor's report. So this one is question, the question here is question number 1A, May 2014. I'm reading the details of the question. It says, outline 4 qualities of good audit report. Outline 4 qualities of good audit report. The examiner in this case is giving you 4 marks if you are to give the qualities. In an area explanation, I did not give you the what? The qualities. But now I can give you the qualities of a good auditor's report. Whether the report is going to be qualified or whether the report is going to be unqualified, a good report, and this is what I tell my student, that a good report does not matter whether it is a police report, an auditor's report, an accountant's report, a teacher's report. It is just a report. And a good report, number 1, should contain accurate facts, should be accurate. Accurate means what? That all the facts contained in the report should be clear, should be accurate, or should be correct. The facts should be correct. So don't give misleading information whenever you are writing a report, because the person who is going to be reading that report is going to be also confused. Number 2, we say a good report should be clear. Clear, we say, is another term for clarity. Clarity will mean that the good report should avoid ambiguous statement or should avoid ambiguity. The report should avoid ambiguity. But can you imagine reading a book and on reaching maybe halfway, you find that the book is not complete. There are so many pages that are missing. And that's why we need, whenever you write a report to any particular person, that report should be what? Complete. So we talk about completeness. Then this one means what? It should contain all the facts. Contain all the facts. The other points we can put here, for example, number 4, we can say a good report should be reliable. Reliable means it can be used for decision making by any person who is going to be placing reliance on it. So it should be productive. Be productive to every person who is going to be using it, and can be used for decision making. For decision making. That will be very, very helpful for that report. But if you go to an organization to audit the company's financial statement, make sure as much as possible you avoid coming up with reports that are not going to give any direction. So give recommendations, or maybe avoid criticizing people without maybe good way of maybe solving those particular cases. So you say, number 5, it should be constructive. Constructive. Constructive means don't make the management to fight with the shareholders, and don't make employees to start fighting with the shareholders. Make sure that your report is constructing the company and everything is coming back maybe to its normal. So it should not be destructive. It should not be destructive to the company. Those are some of the points that we can use. You can also go ahead and add other points. For example, you say it should avoid biasness. Avoid biasness. So don't go reporting in the report that, oh, the management are the one, report to management, are the one who stole from the company, oh, the directors have not been doing this and this, oh, the shareholders have been doing this and this. This one means you are biased. And do not report one particular person, because that automatically will be introducing the biasness. If it is the whole directors, mention the whole director, don't mention a single person. You'll be avoiding that biasness in that case. So reports are reports. It doesn't matter where you're going to be writing that report. All the reports, we usually say they are supposed to be having similar characteristics. And one of the characteristics of the report is accuracy, clarity, completeness, reliability, constructive, and maybe you should also avoid biasness or unbiased. Now, having covered that, and I know you have heard of these particular qualities of a report, having covered that, we can look now on another particular question. I don't think that was a very difficult question. It required you to discuss the qualities of a good auditor's report and get maybe 4 points. The other question from May 2014 is December. So we move all the way to December 2014, and we are going to question number 6. In question number 6, December 2014, I'm going to read the question here. The question reads, explain the meaning of the following types of audit opinion and indicate the circumstances under which each can be issued. I repeat, explain the meaning of the following types of audit opinion and indicate the circumstances under which each can be issued. Roman 1, qualified opinion, 2 marks, and 2, unqualified opinion, 2 marks. And then part B of that question reads, discuss 5 matters that should be included in an unqualified report, 10 marks. So I'm answering a question of 14 marks. 14 marks is not easy, or is not maybe a bad thing if you understand the whole maybe question. I'm in question number 6, remember? And this question number 6 is A and B, and that is December 2014. I think you have understood that one. So the first part that we are answering in this question is we define those particular opinions as well as the circumstances. Maybe before I define, I'll draw a small diagram here, which is going perhaps to give you an overview of the question. This diagram here, you know it because it is used in most of the books to analyze how the audit opinion is supposed to be expressed. Audit opinion arises because of 2 circumstances. We call them nature of circumstances. 2 circumstances. And because the examiner is asking about those circumstances, he's asking about the circumstances where you can give a qualified opinion and the circumstances which you can give an unqualified opinion. So we are first of all going to give circumstances for giving a qualified opinion. Qualified opinion. If you're expressing a qualified opinion, we usually say the circumstance number 1 is called limitation on scope. Limitation on scope. And circumstance number 2 is known as disagreement. Disagreement. Those are circumstances. But if you wanted to know which report you are going to express or which opinion you are going to express, then you need to check whether the matter is material, and pervasive. Pervasive. This one is pervasive. Pervasive or pervasive. This one is material but not pervasive. Material but not pervasive. There. So if you're auditing the financial statement and you have come up with a report and you want to express an opinion, here we usually say express an opinion known as a disclaimer of opinion. A disclaimer of opinion. A disclaimer of opinion arises when the nature of circumstances is limitation of an item that is material and pervasive. Whereas this other one is called qualified opinion. Qualified opinion is expressed whenever there is a limitation on scope, and that limitation is on a matter that is not what? Is material but not pervasive. If a disagreement is material, you are disagreeing over something that is material, we usually say you give an adverse opinion. Adverse opinion. But on the other hand, if the disagreement is not material or is less material but and also not pervasive, then we give a qualified opinion disagreement. Qualified opinion disagreement. A qualified and a qualified opinion are not the same because this one arises because of limitation, this one arises because of disagreement. So there is no way they are the same. They are different. But that is now the nature of circumstances. So when the examiner in this question says, explain the meaning of the following types of audit opinion and indicate the circumstance under which each can be issued. Qualified opinion. I can start with that one here. A qualified opinion should be expressed. Qualified opinion, circumstances. We say, is a type of opinion expressed whenever the auditor is not satisfied with the legal framework. So we say, it is expressed when, (1) the financial statements are misstated. This is when we talk about what? Disagreement. And 2, when the auditor concludes that he has not received enough evidence or maybe sufficient evidence. When auditor concludes that they have not received sufficient and appropriate evidence. They have not received sufficient and appropriate audit evidence. When you have not received sufficient and appropriate evidence, we refer to this scenario as limitations on scope. Limitations on scope should be in bracket there. So a qualified opinion is expressed in those circumstances. So that one expresses the circumstances as well as it defines the qualified opinion. A qualified opinion is given when the auditor is not positive that the financial statements are true. So if you explain that one, you'll get your 2 marks based on that particular part. If you want to explain the other part, which is Roman 2, unqualified opinion, you can say unqualified opinion is expressed. Unqualified opinion, which is the opposite of qualified. Remember, I'm not confusing. This one is expressed when things are not okay. This one is expressed when things are okay. So you say expressed when the auditor is positive. The auditor is positive. Positive is you are very, very 100% correct that they have received all information and explanation, or all evidence, all information and explanations considered necessary. Explanations. That is one. If you go to an organization and you find that proper books of accounts are maintained and there is no misstatement, we say 1, 2, proper books of accounts have been kept. Proper books of accounts have been kept. Then you give a what? You give this type of an opinion, unqualified opinion. And that is the part A of that question. Part A was having 4 marks. The 4 marks wanted you to give the definition as well as the circumstances. There are 2 circumstances when you're expressing unqualified opinion. One is called, qualified opinion. One is called disagreement. The other one is called limitation of scope. Disagreement and limitation of scope are there. There are 2 circumstances, or maybe more than 2 circumstances when you're expressing unqualified opinion. That is when you have received all information and explanation and proper books of accounts have been kept. Then I'm going to part B of that question, which reads, discuss 5 matters that should be included in an unqualified auditor's report. An unqualified auditor's report. 5 matters that are supposed to be included. In this question, the examiner is talking about the elements of the auditor's report. The elements of the auditor's report. Earlier on, I had stated about those particular elements. Now, it is good that we have seen this particular question because now we can explain a few of those particular elements, though not all of them. If you remember, when I was introducing this, I said the elements of the auditor's report are supposed to be 10. The first 5 are, 1, the title. The title is supposed to be using the word independent auditor's report, usually to go ahead and affirm that the auditors have complied with ethical requirements. And the reason about the title is that it can be able to distinguish the auditor's report from other reports that are going to be expressed by others in the company. There is also the addressee, the person to whom the report is going to be addressed, the person to whom the report is meant, usually the shareholders or the members of the company. Number 3, we have what we refer to as the introductory paragraph. The introductory paragraph is very common in exam, and it requires the auditor to go ahead and express a number of things. If you are writing an introductory paragraph, it mostly contains 6 items. 1, it contains a statement that the auditors have audited the financial statement. A statement that financial statements have been audited. That is 1. Item number 2 in the introductory paragraph is the name or the identity of the company, name of the entity whereby we are auditing. So if you're auditing a company like Nation Media, you say Nation Media Group, and that is supposed to be within the introductory paragraph. C, you are supposed to tell us the year and the date to which those financial statement comprises, year and the date of the financial statement that you are auditing. Number 4, or what we refer to as D, you're supposed to tell us the items that you have audited, items that have been audited. In short, you are supposed to identify the financial statement that have been audited. We call this one identity of the financial statement. That is item number 4. Item number 5, you tell us the details relating to pages. Pages in which those financial statements are contained in the annual report. In which financial statements are contained in the annual report. Lastly, in item number 5, that is introductory paragraph, you have to tell us something we refer to as the accounting policy summary. Accounting policy summary that may be audited in that organization. That is the introductory paragraph. It's one of the largest paragraphs that you need to understand before you do an exam. Make sure you can remember the 6 items that are supposed to be contained in the introductory paragraph. Having covered item number 3, because the question is asking about 5 matters that we are supposed to be discussing, those are 3 matters. The 4th matter is what we call the management responsibility. Management responsibility. I think there was a question that we had done about the management responsibility, and we said the management is responsible for preparing and presenting financial statements that are free from material misstatement. The management is responsible for determining accounting policies that are acceptable and ensuring consistency. Then we say the management is also responsible to ensure that assets are safeguarded. That is supposed to be contained there. Number 5, we are supposed to contain what we refer to as auditor's responsibility. So the auditor is supposed to be conducted, or the audit is supposed to be conducted according to the international standards on auditing. Auditor's responsibility. That is supposed to be the last item that I'm going to explain here. However, that is what the examiner is asking. I had said number 6, 7, 8, 9, and 10. And I said this one is called the legal, not the opinion. This one is called the legal matters. And this one is called what? The signature of the auditor. Whereas this one is referred to as the date of the auditor's report, date of the report. And lastly, each and every report must have the location of the auditor. For example, Nairobi, Kenya. These are 5 elements that are supposed to be contained in the auditor's report. So in this question, because it's an open question, it doesn't matter which elements you pick. You can decide to pick this one, you can decide to pick those one, you can decide maybe to combine them and get maybe your 5 points, as long as you can explain 5 elements that are supposed to be contained in the auditor's report. That will be a very simple question. Now, there is also question number 5B in May 2015. Question 5B in May 2015. This question is also about auditor's report, and I'm going to check that question. Question 5B, let me read. It says, Natalie Waheto is the auditor of JRN Limited. She has discovered that she issued an audit report that contained misleading statement regarding the purchase of shares in the company, whose prospectus she reported on. The audit report will generally be circulated to many people who may rely on it to make important investment decisions. Required. Advise Natalie Waheto on 3 steps she should take upon discovering the misleading statement in the auditor's report. So you can imagine yourself, you have completed the audit and then you have issued the report. But after issuing the report now, you have realized that the report was containing some misleading information. So I'm reading that again. Natalie Waheto is an auditor of JR Limited. She has discovered that she issued an audit report that contained a misleading statement regarding the purchase of shares in a company whose prospectus she reported on. And then the audit report will generally be circulated to many people who may rely on it to make important investment decisions. So I'm deleting this part of elements. This one is a question of application in nature because it's talking about a company and activities that the auditors maybe have been doing relating to that particular company. So the company in this question is referred to as JR Limited. The auditors in this question are referred to as Natalie Waheto. So the company name, JR Limited. The auditors are called what? Natalie Waheto. So what Waheto did, he issued an auditor's report with misleading financial information. If you issue a misleading report, then I think you are facing a major liability if you don't correct that particular misleading statement. So when you come across a misleading report or you have issued a misleading report, actions to take are not that difficult. For example, there are those actions that are very obvious. Can you wake up and go to either a lawyer or go to a professional person and seek legal and professional advice? Because from now then, you are facing maybe a major problem from the shareholder. So you say, seek legal and professional advice on that particular case, as well as the implication of expressing that kind of a report. Number 2, if you have issued a wrong opinion and you know it contains misleading statement, you can write a new opinion and maybe express a new opinion and cancel the other one. So you say, issue a new what? A new report expressing the correction of the old report. So because you have made a mistake, now we are trying to mitigate or to minimize maybe the damage. The thing you need to do is now to go ahead and express a new report, give the new information that you have found that maybe is making the other one to be looking misleading. Once you do this, you can also go ahead and appear the AGM. If the AGM in this question has not yet been conducted, why don't you maybe attend the AGM and report that one to the shareholders? So you say, report to shareholders during the AGM, to shareholders during the AGM. If the AGM, for example, you might realize that the AGM has already been conducted and therefore you cannot be able to report on that particular matter, I believe it is always good to go ahead maybe and issue a press statement. This one is just a way of maybe resolving the problem. So you say, issue a notice on the press or media to notify the users of the financial statement that that information is misleading. So in most cases, you need to realize that when the information is misleading, the newspaper can provide that information that is correct. The newspaper is recognized as one way of informing the what? Informing the public and telling them exactly what is not happening or maybe what is happening and is happening wrong. There is a a few other questions I will wish to go through, because now I've done with this one. This one was carrying about 6 marks on the actions or the 3 steps. They were looking for 3 steps that you're supposed to go ahead and do. There is question number 5B, November 2015. Remember, this was May 2015 and it was still question number 5B. So I'm going to question number 5B, but this time in November 2015. This question, I'm reading the details provided here. They say, during the audit of FIDA Limited, you notice the following. 1. There were material deposits in the bank just before the year end and subsequent withdrawals thereafter. 2. Many debtors disputed the amount alleged by the management after securitization. There were also inconsistencies between the dates when the debtors made their payments and the dates when the records were updated, noting that all payments were in cash. Explain the impact of each of the two aspects above. And Roman 2, examine 4 audit procedures that could help you in arriving at an audit opinion in each of the 2 aspects above. Now, this question here, mostly it may look like it's an audit report question, but it is not. These are questions of the audit procedures. The question, though I'm going to answer it because it has a mention of the word auditor's report, but if you read between the lines and you understand it correctly, it has nothing to do with what? Opinions. It has everything to do with auditor's procedure. They are asking, if you are an auditor and you're auditing this company and you come across this particular case, they're saying, number 1, case. There were material deposits in the bank just before the year end and subsequent withdrawals thereafter. So we can clarify this one. If they went to the bank account, and before the auditor came, they deposited money. When the auditor came out, they did what? They withdrew the money. This is what we call a case of window dressing. And there, that one is going to be affecting the auditor's opinion, because this one is also a case of what we refer to as a subsequent event. You have found an event that maybe was not supposed to be appearing in the financial statement. So you tell the management, the simple point here is that any amount of money that is deposited in the bank before the year end and then after the year end, then we are trying to manipulate the financial statement. So the impact is, 1, they are trying to manipulate the financial statement by presenting a better picture than the real situation. Window dressing is a situation whereby the management of the company goes to the bank, deposits money there, which does not belong to the company, and then later on they go ahead and do what? And withdrew. So this one is called window dressing and is going to be indicating better performances than the position that should be there, better performances. Then the other one, many debtors disputed the amount alleged by management after securitization. So if you go to the debtors and maybe after you securitize them, you realize they are disputing the amount, then automatically it means, 1, the money that was supposed to be paid by the debtors has been misappropriated. And that's why they are claiming that they are not supposed to be demanded that money. So that is a kind of a fraud that we refer to it as a what? Teaming and lading. So the 2 effects is, 1, window dressing, the other one is teaming and lading. Money has been misappropriated in that particular question. So I'm leaving that question there, but I'm going to come back again because that's a question of audit procedures. The last part of the question is question 2C, May 2016. We can go to May 2016, question number 2C. In May 2016, question number 2C, the examiner here asks, or maybe the question reads, describe 4 types of audit opinions that an auditor could issue. 4 types of audit opinions that an auditor could issue. I think I had mentioned this one when we were introducing this particular part. And so I'm going to mention this one, which is going to bring to the end of these particular questions. The forms of opinions is what I had referred to them. The examiner here is referring to them as what? Types of opinions. Forms or types, it's all the same. Forms, all types of opinions. So if you are an auditor and you are expressing an opinion, then you can explain, if everything is okay, the financial statement have been prepared in accordance with financial reporting standards, you give a type of an opinion known as unqualified. If you don't want to call it unqualified, you want another name, perhaps you can call it unmodified. It's all the same. That is the type of opinion number 1. It is expressed when the auditor is satisfied that the financial statement reflects true and fair view of the company's state of affairs. Number 2, there is an opinion that is called adverse opinion. And an adverse opinion is expressed when there is a disagreement between the auditors and the management on the financial statement, and the disagreement is material and pervasive. Then number 3, there is a case of opinion known as disclaimer of opinion. Disclaimer of opinion. This disclaimer of opinion should be expressed when the auditor concludes that he is unable to form an opinion, maybe because he was unable to receive all information and explanation he considered necessary, and that is going to be called disclaimer. The number 4 case that we had talked about is qualified opinion. However, qualified opinion, we had agreed, is supposed to be expressed in 2 circumstances. You can express a qualified opinion either because of a disagreement that is less material and pervasive, or you can express an opinion that is qualified because of what we refer to as a limitation of scope that is less material and less pervasive as well. Limitation on scope that is less pervasive and less material. The last type of opinion that you can express, number 5, and I think I had mentioned this one, is called an emphasis of matter paragraph. Emphasis of matter paragraph. This one should be expressed when the auditor is expressing or want to discuss a matter extensively. So basically, this question was also a simple question, and as you can see, it was brought in May 2016, had 10 marks. The first part of the question, no, it had 8 marks. It had 8 marks. 8 marks was, if you explain 4 of them, you will get 2, 2, 2, 2. So you need to explain what is unqualified, you need to express an adverse opinion, and you need also to explain what is a disclaimer of opinion and a qualified opinion. Once you explain that one, I don't think you'll be having any problem in getting the full marks in relation to this question. So I'm wishing you all the best as far as the topic auditor's report is concerned. I think it's one of the most cheapest topic. If you find any problem, you can revisit all those particular notes that we had given, as well as maybe Manifested publish a book, that is a revision kit. That book or the revision partner is going to highlight all those particular items and is going to explain more about that particular case. So until we meet again in our next lesson, I wish you all the best and God bless.
Greetings and welcome to the Governance and Compliance Audit learning session. The topic is on gathering audit evidence. And today we are going to discuss the questionnaires, discussions with board and senior management. In governance and compliance audit candidates, the transition from document review to human interaction is where you uncover the unwritten rules of the organization. In our previous sessions, we looked at the documents that you need as an auditor to review in the process of conducting a governance and compliance audit, like the board papers, the licenses, the charters, the ethical guidelines, the laws, the internal policies. Those are documents. You have to review all those documents. But after reviewing the documents, you need to transition from just document review to human interactions, where you conduct discussions or interviews with the board and also the senior management. And through such discussions, you will uncover the rules that are unwritten, those unwritten rules of the organization. And while policies show how things should work, because policies are documents, they show how things should work. But the confidential discussions with the management will reveal how they actually work. Because it's one thing to have instructions, and it's another thing to have the instructions being carried out. So the shift from document review to human interactions through discussions with the board and management is a crucial step. It is an essential step for assessing the tone at the top and also identifying cultural gaps that data alone cannot detect. So in this lesson, we are going to study the purpose of the structured format, because when conducting discussions or when interacting with the board and senior management, you have to do it in a structured manner. You understand? So if you are to do it in a structured manner, then what are the core themes for the structured format or the questionnaires that you are going to use? That we'll study in our today's lesson, the core themes. Then we'll also have a time to discuss the best practices for high-level interviews. So firstly, what is the purpose of having a structured format? Purpose for structured format. One, purpose for structured format. If you are using, say, questionnaires to get information from the management or the board, what is the purpose of doing it in a structured manner or format? Now, using a structured format like a standardized interview guide or survey is non-negotiable for three reasons. The first reason is comparability. Comparing. It allows you to compare the views of the board against those of the senior management. Because you have it is structured. So you compare the views of both the board and the senior management to see if there is any strategic misalignment. You can send the same questions to both the board members and the senior management. Then you compare the responses. That will reveal if there is any misalignment in strategy. The other reason is objectivity. Objectivity. That's the second purpose for having a structured format, objectivity. It prevents the auditor from being led by off track. You can be led off track by those you are interviewing. So to avoid being led off the track, you stick to the structured format. You don't veer off what is contained in the questionnaires or surveys. Reason number 3, data aggregation. Structured format supports data aggregation. It allows you to convert qualitative opinions into quantitative data for scoring. You remember what we talked about scoring? Assigning numerical values to qualitative data. That is possible when you have a structured format for questionnaires. So these are 3 main reasons for having a structured format. Now the second thing we are going to discuss in this question is survey versus the confidential discussion. The survey or questionnaire versus confidential discussions. So there are 2 things. You can do survey or have discussions. Now a successful audit uses what we call a pincer movement, which combines both the questionnaire and confidential discussions. Understand? These are 2 methods. Survey, not surveyor, but survey. Survey and confidential discussions. Survey. Now, the questionnaire candidates, the questionnaire survey versus confidential. So the questionnaire or the survey is broad. It has a broad reach. You can do a questionnaire to the board, to the potential middle level managers, to the management, and so on. It is wide. It also focuses on perceived effectiveness of controls, ethical climate, resource adequacy, and so on. You can do a questionnaire and deliver it under what we discussed earlier, the governance risk control tools. You can use the GRC tools, or you can use encrypted survey platforms when you are doing questionnaires or survey. Then there is the confidential discussions. This one covers a selected individuals. You may have confidential, for example, discussions with the chair of the board, or the chair of the audit committee, or the CEO, or the head of risk. You select a few heads. So confidential discussion is not as wide as survey or questionnaire. Survey is wide, it covers a wide range of people. Confidential discussions, you select a few. Understand? And the scope here is it focuses on sensitive issues like boardroom dynamics, the management overrides. When you are having these discussions, you limit your discussions to the board dynamics. If there is any management overrides or near miss incidents that were not reported, that they can be unearthed when carrying out confidential discussions with a few individuals, like the board chair, the audit risk chair, the risk management committee chair, and so on. So that's a very important thing to note, that when having discussions with the board and senior management, you need to first of all have a structured format. If you are doing a questionnaire or survey, it has to be structured. Then you need to combine both questionnaires and confidential discussions method. Combine the two. Combine both methods. Understand? Yes. And the format for confidential discussion, this one is one-on-one, face-to-face. It is one-on-one. It could also be off the record. One-on-one, off the record. One-on-one, off the record. It should be off the record to an extent. And it should be guided by open-ended but pointed questions. Open-ended but pointed questions. Try to make it off record so that the one you are interviewing is free to give you the information that you may need without any fear, or without an environment that is not conducive for open discussion. So then, number 3, what are the core themes of what are the core themes for the structured format? Here we are talking about, when you say open discussions, we are just referring to interviews. These are just interviews, questionnaires and interviews. You use both questionnaires and interviews. So what will be the core themes for the structured format? So the questionnaires and interviews should be clustered around specific governance pillars. One is board effectiveness. Board effectiveness. That is one pillar. When having discussions with the board and senior management, one important thing that you should not leave out is board effectiveness. For example, do members feel they receive information early enough to make informed decisions? You need to find out. Risk appetite, another key theme. Risk appetite. Risk appetite. Is the board's risk appetite clearly understood by the management? How about compliance culture? What is the compliance culture? Would an employee, for example, feel safe reporting a superior's non-compliance? Those are questions that you need to ask. resource sufficiency. Resource sufficiency. Does the compliance or internal audit function have enough budget and teeth to do their job? So these are core themes when using the questionnaires and interviews to get information from the board and senior management. That is what we are discussing, number 3. Then number 4, best practices. Important for us to understand some of the best practices for high-level interviews. One is the rule of independence. When conducting these interviews, there is a rule of independence. What do we mean by rule of independence? Now, if the auditor is internal, these discussions may be facilitated by an external legal auditor to ensure the board feels comfortable speaking freely about the CEO. That is the rule of independence. Then there is non-attribution. 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 You need to guarantee that specific quotes won't be linked to the individual in the final report. There are certain issues which the board chair or the chair of the audit committee may reveal, which you may not need to attribute to them when you are doing the final report. Guarantee. You need to guarantee the interviewee that certain quotes will not be part of the report. Then there is the evidence loop. Evidence loop. If a board member claims a specific control exists, the auditor must later verify this during fieldwork. Understand? Yes. So these are very important points when it comes to gathering audit evidence from the board and senior management through questionnaires and interviews. Understand? Now, when interviewing, again, in closing candidates, these senior management members and the board, is critical for you to also be checking and listening for what we call the red flags. Be able to see the red flags. When interviewing, listen for statements like, we don't really follow that policy. In just discussing, you may hear the board chair say, or the CEO, we don't really follow that policy. It's just for the regulators. That is a red flag. May be said casually, but it's a red flag. Or you may hear the statement like, the board only sees what the CEO wants them to see. The board sees only what the CEO wants them to see. That's another phrase. Another statement that can indicate a red flag is when you interview some of this senior management and you hear one of them say, we are too busy with growth to worry about the finer details of compliance. We are too much focused on growth because that's what is the most important thing. We don't have time to focus on the finer details of compliance. That's another red flag. Understand, candidates? Yes. So that is the end of our today's lesson on questionnaires or confidential discussions with the select board members or the senior management. We've discussed 3 themes, right? Purpose for structured format. You need to have a structured format when you are developing a questionnaire because of comparability. You may need to compare what the board says and what the senior management says, so that if there is any misalignment, you can notice when it's structured. So there's also the issue of objectivity and data aggregation. Data aggregation means being able to convert qualitative data into numerical form. There is a second part we discussed, which is questionnaires versus interviews. Then we've also outlined the core themes when seeking information from this senior management. One is board effectiveness, risk appetite, compliance culture, and resource sufficiency. Then there is also best practices. We discussed the best practices. In closing, we also mentioned something on the red flags, potential red flags to listen for. That's the end of the lesson. Thank you. God bless you. Bye-bye. Greetings, candidates, and welcome to the lesson. Today we are going to begin on the new subtopic on data visualization. And in this subtopic, we will cover the definition of data visualization. Number 2, the benefits of data visualization. Number 3, types of data visualization. And number 4, qualities of good data visualization. So those are 4 areas, but in today's lesson, we'll focus mainly on the definition of data visualization. In this lesson, we define data visualization. We'll also identify the visualization tools, specifically in Excel. Then we will give 3 reasons why data visualization is essential. 3 reasons. So those are the 3 things we are going to do in today's lesson. First of all, we define data visualization, which is a graphical representation of information. Data visualization is the graphical representation of information. You may have information in form of text, in form of videos, in form of numerical. So when such data is presented in a visual way, we say that is data visualization. And we use visual elements like charts, graphs, maps, and so on. So by using visual elements like the charts, the graphs, the maps, data visualization tools provide an accessible way to see and understand trends, patterns, and also outliers in data. And in the context of big data, data visualization is a process of summarizing millions of data points into a single visual story. Because you recall, one of the characteristics of big data is that big data has comes in large volumes. So if you have large volume of data in form of millions of data points, those millions of data points can be presented in form of a picture or what we are calling data presentation, a graphical presentation, so that it is possible to easily understand the data. Are you following, candidates? Yes. In the context of big data, data visualization, I repeat, is a process of summarizing millions, if not billions, of data points into a single visual story or picture. And this visualization requires specialized tools like Tableau, like Power BI, and so on. But we also have Microsoft Excel, which remains to be the most common entry point for data visualization. So Excel allows users to transform static tables into dynamic visuals. And these standard tools could be standard charts, the tools. These are the tools we may use in data visualization. One is the standard charts. And this could be the bar charts, the column charts, which is best for comparing categories like sales by region and so on. We have the line charts. You can use line charts, which are ideal for showing trends over time, like monthly revenue and so on. Pie charts is another tool that we can use to present data that is used to show proportions of a whole. Understand? Yes. Bar charts. I mentioned bar charts. You can use bar charts. The number two is the conditional formatting. Conditional formatting. Conditional formatting. Now, this visualizes data directly inside cells using color scales, using data bars or icon sets. For example, highlighting all cells where profit is negative in red. You have pivot charts or tables. This is another tool, pivot charts. These are linked to pivot tables. The pivot charts are linked to pivot tables, and they allow you to filter and slice through large data sets to update the visual instantly. These are pivot charts. Then another tool that we get in Excel is the sparklines. 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 These are tiny charts that fit inside a single cell, providing a quick visual trend next to a row of data. So these are some of the tools that we get in Excel that can be used in data visualization, which is the graphical representation of information. Then, candidates, what then is the importance of visualization? Why is visualization essential? Why? Why do you think it's important to represent information in form of visuals. Now, we need to understand that it is wired to process images much faster than numbers and text. That's why when data is presented in visuals, in charts, in bar charts, in pie charts, in line charts, in pivot charts, in sparklines, when that information is presented in such format, then it becomes very easy for the human mind to process such data, to understand that data very quickly. So visualization solves three specific problems. One is clarity, then the other one is efficiency and discovery. Why? Number one, clarity. Visuals simplifies complex relationships. For example, you may have scatter plot that immediately show if there is a correlation between, say, advertisement spent and sales. Clarity. Number two, efficiency. Efficiency. For example, a CEO can look at a dashboard for 30 seconds and understand the health of a company just in 30 seconds without reading the financial statements and all that. You can just look at the diagram and understand the financial position or health of a company. Whereas reading the underlying spreadsheets might take many hours. But a diagram, a picture can help the CEO to understand the financial health of an organization. Another reason why this data visualization is important is due to discovery. Visuals reveal hidden stories. You might not notice a single data entry error in 10,000 rows. But on a graph, right? But on a graph, that error will appear as a massive or an obvious spike. You can identify a problem in a graph than in 10,000 rows, because the information that is in 10,000 rows can be presented in a picture. So it becomes very easy to discover any error presented graphically. You can also see patterns when they are presented, when information is presented graphically. Because as we said, data visualization tools, we said these tools provide an accessible way to see and understand not only trends but outliers and patterns in data. And that's candidates the meaning of data visualization. It is the graphical representation of information or data. And in Excel, we may use tools like the standardized charts, the line charts, the pie charts, the bar charts, conditional formatting, pivot charts, sparklines, and so on. That's the end of today's lesson on the definition of data visualization. Bye-bye.
In the Kenyan, regional, and global context. Mergers and acquisitions in the context, in the Kenyan, regional, and global context. Those are three things. First, you have the Kenyan context. And Kenya candidates has seen a rise in mergers and acquisitions, which are driven by various factors like economic growth, like market consolidation. And one reason for mergers and acquisitions is increased foreign investment. You understand? Kenyan context. Let's first briefly analyze mergers and acquisition in the Kenyan context. Here in Kenya, we've seen companies merging, we've seen companies acquiring others, and the reason has been because of the economic growth in the country, because of market consolidation. We've had also increase in foreign investments, and there has been mergers and acquisitions in various sectors, various industries. We've seen banks merging, that is the finance sector. We have telecommunications, we have areas to do with the consumer goods and so on. So one reason for the mergers and acquisitions in the Kenyan context is a growing market, because market has been growing. Growth in the general market. Now, in trying to understand mergers and acquisitions in the Kenyan context, you may also need to look at the regulatory framework. The regulatory framework, for example, we have the Competition Authority of Kenya, which plays a crucial role in issue. We also have other regulatory bodies such as the Capital Markets Authority, the Central Bank, and so on. These bodies oversee mergers and acquisitions in the respective sectors. So again, we have regulatory acquisitions. That's why we've had successful mergers and acquisitions in the Kenyan context. In understanding mergers and acquisitions in the Kenyan context, you may also have to maybe discuss something to do with strategic drivers. Companies pursue mergers and acquisitions to expand their market share, to diversify their operations, and also gain access to new technologies. All right, we have strategic drivers, which I've mentioned. Strategic drivers. Mergers and acquisitions are driven by certain factors. You understand? Mergers and acquisitions in the Kenyan context. Then you have regional context. Mergers and acquisitions in the regional context. And regional context, here we are referring to the East African integration or community. The East Africa community promotes regional integration, leading to increased cross-border mergers and acquisition activities. And Kenyan companies are actively expanding into neighboring countries, and also companies in neighboring countries are also expanding their operations into the Kenyan market. So we have the East Africa integration, East Africa community. We also have COMESA, the common market for Eastern and Southern Africa. COMESA also influences mergers and acquisition activities. COMESA also has regulations that apply to transactions in multiple member states. You understand? Then we have also regional banking expansion. Kenyan banks have been particularly active in regional expansion through mergers and acquisitions. An effort which seeks to tap into the larger Eastern African market. Global context, mergers and acquisitions in global context. Mergers and acquisitions in global context. These mergers are influenced by global trends. Global trends. What do we mean by global trends? Now, the global mergers and acquisition trends influence activities in Kenya and even the region. Factors like technological advancements, We have factors like the economic conditions, the geopolitical events. Such factors play a significant role in mergers and acquisitions in a global context. You understand? So global trends are influenced by technological factors, technological advancements. We have factors like the geopolitical events, the geopolitical events which influence mergers and acquisitions in the global context. Economic conditions also play a crucial role. Global economic conditions. Global economic conditions. You understand? So, apart from what we've discussed, we also have cross-border deals. All right? Cross-border deals. Kenya is increasingly involved in cross-border mergers and acquisitions, both foreign companies acquiring Kenyan businesses and Kenyan companies acquiring foreign businesses. I've talked about also the technological influences. We have global technological advancements which are driving mergers and acquisition activities. Companies are merging to gain access to new technologies and also digital platforms. So do you understand, candidates? So that's what we can say about mergers and acquisitions in the Kenyan, regional, and global context. Kenyan, regional, and global context. In this lesson, we've learned that Kenya has seen a rise in mergers and acquisition activities, which are driven by many factors. I've mentioned growing market. Kenya has put in place regulatory framework. We also have certain other strategic drivers where companies pursue mergers to expand market share, to diversify their operations, and also to gain access to new technologies. We've gone ahead to discuss mergers and acquisitions in the regional context. In the regional context, here we are referring to the East Africa Community or East Africa Integration. The East Africa Integration and COMESA. The East Africa Community, we know, promotes regional integration, which to some extent has led to increase in cross-border mergers and acquisition. We have Kenya companies now operating in Rwanda, others are operating in Uganda. We have banks that have opened branches in Tanzania, and so on. Then we have COMESA also, which promotes regional integration. COMESA, the Common Market for Eastern and Southern Africa. It influences mergers and acquisitions. COMESA has regulations that apply to transactions involving multiple member states. We've seen Kenya banks which have been particularly very active in regional expansion through mergers and acquisitions. You understand? Then we have the mergers and acquisitions in the global context. Global context, we have global trends, which influence activities in Kenya and even the region. Due to factors like technological advancements, we have geopolitical events and economic conditions. All these influence mergers and acquisitions. So candidates, that marks the end of today's lesson. We've briefly discussed mergers and acquisitions in the Kenyan, regional and global context. Thank you. I'll meet you in another lesson where we continue to share knowledge in advanced financial management. Bye-bye.
I greet you all, and how are you? My name is Mr. J.M. Kimani, a lecturer in Advanced Management Accounting. I welcome you to our revision of topic 6, the inventory control decisions. This is sample paper 2, still featuring on economic order quantity. Now, our sample paper 2 made up of a question that is from August 2009, the pilot paper. Question 3. Question 3 part A reads that Mavuno Limited produces 2 products, namely A and B. The standard production cost of product A and B are given as follows. There is the product A, B, amounts are given in shillings. Raw materials purchased from external suppliers, 13 shillings and then 8 shillings respectively. Standard cost of product B transferred is 22 shillings and then dash. Labor skilled, 9 shillings, 5 shillings respectively. Unskilled is 7 shillings, 4 shillings respectively. Variable overheads, 5 shillings, 3 shillings respectively. Fixed overheads, 4 shillings and 2 shillings respectively. The total cost per unit is 60 shillings for A and then 22 shillings for B. Then information number 1, the annual demand of product A is 4,000 units. The demand is met in 4 production runs of 1,000 units each. Then number 2, product B is used as an input for product A and sold externally as a final product. Number 3, included in the fixed overheads for product A are the setup cost. The setup cost for each production run are as follows. Labor cost, skilled labor, 66. Machine parts replacement is 70 shillings. Total is 136 shillings. The setup cost relates to the production run of any size. Then number 4, production of product B runs throughout the year. Number 5, each unit of product A in stock requires 0.4 square meters of storage space. Warehouse rent per square meter of space is charged shillings 20. Units of product A cannot be stocked on top of each other to reduce the storage space required. Number 6, warehouse rent is paid for actual storage space used. And number 7, the financing cost for product A is 15% per annum. And number 8, Mavuno Limited is not working to full capacity and idle time payment are being made to all grades of labor except unskilled workers. Required. Roman 1. Determine the optimal batch size for product A if it differs from the present policy and calculate the annual savings to be made from pursuing the optimal policy. And Roman 2, lastly, briefly describe 2 limitations inherent in the practical applications of the model used in A1 above. End of question for part A, that is. Now, let's first of all work on this part A, then we look at part B afterwards. Now, you have been given 2 products, which are final products, product A and B, but product B is used as an input to product A, and therefore product A must comprise the cost of product B. So when we talk of product A, the cost of it should include that of product B. You have been told that currently the demand is 4,000 units, but currently we are producing 1,000 units each time. That tells that we are doing 4 production runs. Then you also told that there is note number 3, which is about the setup cost, which is 136, and it is good because you have been told that it is for any size, which is true. The setup cost or the order cost must be for any size of order or any size of setup. Then at the same time, we do have that product product B is produced throughout the year, and therefore we do not have the don't have breakage. And then note number 5, you have been told information about the storage. The space that product A requires, which is 0.4. Warehouse rent per meter square is 20 shillings, so you can be able to determine there, and that would be our starting point. But at the same time, as we are told, determine the optimal batch size for product A if it differs from the current. So first of all, this is about producing the final product but using some material. But since it is production, we can have it this way. So it can also be EOQ and EBQ because of the requirement here. So you can have it this way. That this is, remember, this is August 2009, question 3. So we are doing part A first. So we will need the EBQ or EOQ, since it's a final product, which is a 2DS as the setup. We divide by CH. We can have this one as the R, just to avoid confusion with what I did in sample paper 1. So it's 2RS divided by CH. We don't have a percentage. We don't have a case where we are storing part and part is being used. We don't have that. It's a continuous process. Therefore, we only have that part left aside, 1 minus U over P, as we did in sample paper 1. So that one is missing and don't have it. But this is what we have. So you can say where R is the requirement, which is the demand, and it is given in note number 1. It is 4,000 units. S, the setup cost. This has been given in information number 3, that it is 136 per setup. Then when it comes to CH is going to be the holding cost, which have been given in information number 5, and also we'll take note number 7, the financing cost. So we're going to have here, this is a storage cost plus the financing cost. These two, storage cost plus financing cost. The storage space is given there as we are using 0.4 square meters, and every square meter is 20 shillings. So that means we'll be having here 0.4 multiplied by 20. That will be like 8 shillings. And then we are going to add 15% of the cost. So we can talk of the variable cost here. So where? So the variable cost of product A, variable cost of A, which remember comprise of B, as we do have here 60 shillings, we are going to less. In this 60 shillings, there is the fixed overheads, which is 4 shillings and 2 shillings. So this is a 4 plus 2. This is fixed overheads. Then minus another item which is not variable and does not depend on the storage, as we have been indicated and given in note number, where is it? We have it note number 8, that Mavuno Limited is not working to full capacity and idle time payment are being made to all grades of labor except unskilled workers, meaning the labor we are paying, especially the skilled one, it's like saying that is a constant amount, because whether they are working or not, we are paying them. We are being told that we are paying idle time. So therefore, the labor skilled, we would say it is irrelevant because it's a constant amount. It does not vary with what we produce. So therefore, we are going to subtract it as a irrelevant cost. So this is skilled labor, which is 9 plus 5. This is 9 plus 5. This is skilled. Why? Because it's remaining constant as we have been told in information number 8. Otherwise, the information number 6, warehouse rent is paid for actual storage space used, which is that's why we have taken this cost here. Is okay. I do not see any other item affecting, and that is all. So we have actually factored in all the material cost, the labor and skilled variable overheads. I've only subtracted the fixed as well as the labor. So this now will give us an amount of, so this is 60, you subtract this is 6, and you subtract this is 14. So that means you'll remain with 40 shillings. That is now our variable. So in this case now, when it comes to determining the holding cost, so we'll say that therefore holding cost will be 0.4 in bracket 20 then plus 15% of 40 shillings. So how will this be? So this is 0.4 times 20 shillings, then plus 0.15 times 40 shillings. This is coming to 14 shillings, 14. So I'm having that, I have it set up, I have the requirement. So with that now I can be able to determine my EBQ or EOQ. So you say that therefore EBQ shall be square root of 2 times 4,000 times 136. You divide this one by 14 shillings. The number of units here we require would be what we should be producing every time, 2 times 4,000 times 136. You divide by 14, then square root of it. This would give us 279. 279 units. Now this is what we should be producing, and as much as we have been asked determine the optimal batch size for product A if it differs from the present policy, and calculate the annual savings to be made from the pursuing the optimal policy. Now this being the optimal, first of all, how many batches, how many setups are you going to make? So you can say here that the number of batches or set ups, which is R over Q. So this is going to be 4,000 divided by 279 on average. This will be 4,000 divided by 279. This will be approximately, let's say 14.3. So which you can see this one is more than the current one of 4, because current one is 4, but the proposed one is this. At the same time, this EBQ is also less compared to the one given there as to 1,000. So with this now, we can be able to work out the cost. So we're going to have here total cost equals to, the production cost does not change, it's the same cost, but what changes now is the size. When the size changes, it only affects the holding cost and the setup cost. So otherwise production cost is going to be the same cost of this one of 40 shillings on the units which are, it is 4,000. So we don't need to have it in place. So you can have this one as the Q over 2 CH plus R over Q S. So therefore, we are going to have, this is a current policy. Our Q is 1,000. Our Q is 1,000 as you are given there, and nothing else changes. Everything else is constant, but now the Q is 1,000. So therefore, our total cost shall be 1,000 divided by 2 multiplied by CH is 14 shillings plus 4,000 divided by 1,000 times 136. So meaning currently the cost we are spending is, this is 1,000 divided by 2 multiplied by 14 shillings. Then you add 4,000 divided by 1,000 multiplied by 136. This is giving us shillings 75.44. That's what you are spending currently. But now the optimal policy, where the quantity we have found it to be 279. Therefore, total cost shall be, we have 279 divided by 2 multiplied by 14 plus 4,000. This is 4,000 divided by 279 multiplied by 136. So this is going to give us an amount of 279 divided by 2 multiplied by 14 shillings. Then you add 4,000 divided by 279. Then you multiply by 136. This is giving us shillings 39.03. Look at this. This, what we are to spend is lower than what we are spending currently. So what is the savings? So we can say that we have been told about the annual savings. So calculate the annual, So you can say that therefore annual cost savings will be the 75.44 minus 39.03. This will be, so 75.44 minus 39.03. This will give us shillings 36.41. It's very interesting that we are going to cut down the cost by almost half, because you can see we'll be spending that 9 cutting 36. So we need to actually take up this optimal policy with all means, because it is going to save the cost. Now the implication is that it seems that the setup cost is so cheap compared to the holding. That's why we have proposed, or we have found it necessary to lower the size of batch, so that now if the size of batch is small, we can have so many batches. The batches are going to be 14, as you can see, while the current policy we are only having 4 batches. But it seems that we are keeping and we are spending so much when you are storing 1,000, spending so much. But here we are proposed to only spend on 279. That means there is so much expense concerning the holding than it is on the setup. That's all. Then you are asked also Roman 2 that briefly describe 2 limitations inherent in the practical applications of the model in above. So one, the assumptions and the limitations involved, because the assumptions are the same limitations, is that we normally assume that the production rate must be higher than the usage rate. That's the position. For EBQ, normally we say that production must be more than the usage rate. And we also assume that the annual demand or requirement must be constant, must be assumed to be constant, and even to be even within the year. So even means that is the same rate per specific period. If it's per month, it's the same. So it's spread evenly. Then number 3 is that the holding cost, as you have found here, holding cost of 14 shillings to be constant for each and every unit, to be constant for the whole period, as well as another one is about the setup cost to be constant for each and every setup or order or batch. At the same time that we are assuming that this is a certainty where there is no case of stockouts, no shortage, because if the demand is known and everything else remain constant, then there is no need of us having shortage or stockouts. Also, we normally assume that the replacement is instantaneous. This means that if you are replacing, if you are producing these, if you want this 279, we are assuming that we get them instantaneously. If it's production, if it's supply, we normally assume that we receive it at once. Otherwise, when it comes to EBQ, specifically when it comes to production, if the batch is more than the production rate, automatically that means we need some days to build up the stock. So that time we don't have instantaneous replenishment. We normally have gradual replenishment. But especially for EOQ, it must be instantaneous replenishment. Also, the length of production run should be constant. If you take 10 days to produce, we should be having the 10 days for the first batch, 10 days for the second batch, like that. It should be constant every time we are producing. And also, most importantly, the variable cost of production or the purchase price should remain to be constant at all time. That is, or those are the assumptions that are necessary in this case. Now, before we go to part B of that question, unnecessary and also very relevant, just like this question you have done, it is in June 2010. I just want to have some similarity of this question. What you have done and what was asked in June 2010, that was like after like 2 sittings there. What was asked in June 2010, question 2, part B. So June 2010, question 2, part B, still on savings, change of policy and having some savings. So this is how it is. We are told that Ujuzi Limited sells a unique product Q. The following budgeted information relates to the product Q for the next production period. There is sales 4,200 units at shillings 85, giving us total of 357,000. Opening stock is 200 units at shilling 65, giving us 13,000. Purchasing department cost, there is variable, which is 7 orders and each order is shillings 300. Total is 2,100. There is fixed cost, which is an amount of 8,400. Purchases 4,200 units at shilling 70, giving us 294,000. Transport cost 7 trips. Each trip is 750, giving us total of 5,250. Fixed warehouse cost is 43,000 and closing stock is 200 units at 70, which is 14,000. Then information number 1, insurance costs are set at shillings 4 per unit based on the average stock holding. The average stock holding is 500 units. Then number 2, the transporter has proposed to reduce transport cost to shillings 650 per order if the company increases the order size from the current 600 units to at least 1,000 units. Number 3, buffer stock is currently 200 units. And number 4, the company has contracted to buy 4,200 units during the year. And number 5, transport cost is to be paid for at the beginning of the year. And then number 6, cost of capital is 20% per annum. And number 7 is assume that sales take place evenly throughout the year. Required Roman 1, the economic order quantity if the company is to take the transport offer. And number 6 is improvement in net profit, if any, as a result of adopting the new EOQ. End of question. Now you are given the present and the current policy, which in note number 1, you're told that the average stock holding is 500. That is what we are having as average, which, you know, average stock holding means like the way we have done here, Q over 2 is like saying 500, and it's like saying that the order would be 1,000 in this case, if you were to follow it. Then we are given the insurance cost is 4 shillings, and we are going to make some comparison there. So let's have it this way. We are told the EOQ, we need this. This is Roman 1. EOQ, this is square root of 2DCO divided by CH. So you can say where demand remains to be 4,200 units, not changing. The cost of order, the ordering cost, we do have the current one and we do have the proposed one. The proposed one, you've been told that is where you have the transport cost changing. First of all, from the list of question given there, you are given purchasing department has a cost per order. This is purchase department cost per order, that is, and we do have the transport also. So we have transport cost. So we do have, this is the current. So current will be purchase is 300 per order, and we have plus transport cost currently is 750. So that means we are incurring shillings 1050 currently. But the proposed shall be 300 the purchase department, but now we have been told that if we are to buy above 1,000, what is it? We are told that the transporter has going to give us a lower price for us to buy if the company increases the order size from the current of 600 to at least 1,000 units. So at least 1,000. Therefore, this will be 650. So this cost will be shillings 950. So this is another difference. So these are proposed, these are current. So we're going to absorb them accordingly. What else do we have? The holding cost per unit. Holding cost, we do have already the information number 4. This is insurance. Then we add insurance cost. Then you have the note number 6, cost of capital. So cost of capital. This one, first of all, insurance is 4 shillings, as we are given note number 1, 4 shillings per unit based on the average stock holding. And then we come to information number 6. The cost of capital is 20%, so plus 20% of the cost of this. We are buying this one at a cost of 70 shillings as provided there, 70 shillings. So this is going to give us an amount of, so if you multiply, this is already 14 plus this is already 18. So you're having 18 shillings the cost of holding. That is clear. So we are going to substitute this way. So therefore, EOQ is going to be 2 times the demand. Demand is 4,200. The cost per order, a proposed one, is 950 divided by the holding cost is 18 shillings. So this now will give us what EOQ. So if you calculate, this will be 2 times 4,200 times 950. You divide by 18 shillings. Then square root of this will give us 665 or 666. This is the units. But now, unfortunately, we won't be able to take advantage of these transport costs, because you see now we are to buy 666, but the transporter has told us categorically in information number 2, the transporter has proposed to reduce transport cost to shilling 650 per order if the company increases the order size from the current 600 to at least 1,000. So in this case, we say that the EOQ is 666. However, quantity is going to be 1,000 units because of that transport cost. We cannot take the advantage of 650 if we are going to order 666. we must order what? 1,000. So this is just, however, we must have at least 1,000. But the EOQ is what? 666, and that is the position. So you have been asked that in Roman 1, if the company was to take the transport offer, then we must have 1,000. Now, so that we can be able to answer Roman 2, which is asking us about the improvement in net profit, if any, as a result of adopting the new EOQ. So we'll have, first of all, here, this is total cost, which is, of course, as per given in the question there, where we have, we do have the current cost we can work out, and we do have also the proposed, which is now going to be using this. So we can have here that is purchase cost plus holding cost plus we do have the order cost. So this is going to be the demand times the cost or the price we incur, then plus this is a Q over 2. We multiply by the CH plus D over Q, we multiply by the CO. So we can have here, first of all, the proposed. Proposed will be, so proposed Q will be, of course, 1,000. So therefore, TC will be, we have 4,200 at a cost of 70, as we are given there. Then we add, this is going to be Q is this 1,000 divided by 2 multiplied by, this is 18 shillings, then plus this which is for 200 divided by 1,000 multiplied by this cost, which is cost per order. So proposed one, of course, it is 950. So this will give us an amount of, so this is 4,200 times 70 plus 1,000 divided by 2 times 18 plus 4,200 divided by 1,000 times 950. This is shillings 306,990. Now this is the cost that we are going to spend currently. Now, as in a proposed. But if you are to go to the current, having been given the statement, you can be able to determine by taking the purchases cost, also the purchase department cost, the transport cost, and also all those together. So you can even substitute this way. This is the current cost or current. We just need to substitute the Q in this time. Q, we have been told it is 600, and it is true because you see, for 200 being the demand for the whole year, if you order 600 every time, that means it will be 7 times, and that is very true. So you'll have here that TC equals to 4,200 years, each at 70. That will not change. Then this is 600 over 2 multiplied by 18, no changes. Then plus 4,200 divided by 600. You multiply by, now the transport transport cost is not 650 this time. The current one is 750. Therefore, we are talking of 1050. So this will give us a total of, if you want to multiply, this is 4,200 times 70. You add 600 divided by 2 times 18, then plus 4,200 divided by 600, which is multiplied by 1050. This is actually giving us shillings 306,750. So you have it that way, that we are having 306,750, which is showing that currently is going to be cheaper, 306,750, and like this one, which is going to be 306,990. Therefore, this is going to be a decrease. So this decrease in profit, which is the same as increase in cost. Should you take the proposed? You see the proposed is actually 306,990 minus 306,750. As much as the cost will increase by an amount of, this is 306,990 minus 306,750. This is 240. Now the cost is going to increase by 240, but that will tell you the profits are going to decrease by that 240. Now the point is this: if you were to go with our EOQ, if it would be allowed, automatically it would make some savings. But now, because we have not worked with 666, since it's not possible for you to order 666 and you get a transport cost of 650, that's why we have worked with 1,000. You can see here that the proposed quantity is 1,000. So because of that, the cost seems to be higher. But if you were to work with the 666, the cost would have been cheaper. But now the question is, we are not the ones, we are not giving ourselves this cheaper transport cost. It is a transporter who is going to demand, and is demanding that you must order not less than what? 1,000. And that tells you that we are restricted to work now with the 666. We work with 1,000. That's all about it. So therefore, for this one, there is no savings we are making. This one will be a cost. So we better remain with our current policy, unlike where we go with the proposed, and that is the position. Or we can negotiate with the supplier to accept our 666 or any figure which is very close to this 666. But 1,000 seems to be so high, and that's all. So last but not least, we have we go back to the August question. This August 2009 question 3. Now we look at part B. We have done part A, so we look at part B, August 2009. So part B, which reads that, part B of this question reads that, BD Limited buys for resale product K from ginger suppliers in Uganda. The annual demand of the product is estimated at 10,000 units. The unit cost of product K is shillings 20, while the ordering cost per order are shillings 100. Ginger suppliers have recently introduced an offer for bulk purchases. The details relating to the offer are as follows: quantity in units and then unit price. Up to 999, the unit price is 20 shillings. 1,000 up to 1,999, that is 19.8, and 2,000 and above is 19.6. The prices are changing. Additional information number 1, you're told the procurement manager proposes that the company should take advantage of the quantity discounts and acquire the product at the lowest possible price. Number 2, holding costs for product K are estimated at shillings 8 per unit per year. Required. Advise the management of BD Limited on the optimal order quantity given the offer for bulk purchases. So we advise the management whether to take these bulk purchases. Now, of course, this question is about discounts, and especially multiple discounts. If you're given multiple discount, how do you go about this? So for this one, we are going to analyze and have some comparison, where we're going to have this now part B, August 2009, question 3, part B. So this is multiple discount. So part B, multiple discount offer. Discount offer. Now, when you are given such, you need to check whether the optimal quantity that you would buy, as what we would call the EOQ, whether it falls within the range or falls above or falls below the range. That now you can be able to evaluate. Now, for us to do this, we require to know the EOQ. So we have this way. So EOQ for each price, EOQ equals to 2DCO divided by CH, where the demand is constant, D is constant and provided there as to 10,000 units in the first line up there, 10,000 units. Then CO, we have been given clearly in the second line, the unit cost of a product is 20 shillings, while the ordering cost per order is shillings 100. But then the holding cost currently, when we are purchasing at 20 shillings, the holding cost is 8 shillings. We can have here is 8 shillings. That is, should you want to know whether the holding cost will be changing as the purchase price changes, if it's changing, then we will have it this way. We'll have, it is actually 8 shillings out of 20 shillings. And this is going to be 0 points. So this is going to be like 0 point, or either, is it for 0.4? Let's see. 8 divided by 20. 0.4 that is. That what I mean is, if the holding cost will change as the price changes, then we need to have it as 0.4 of the price, which is 40%, which is like the cost of capital. But if it's not changing, then we'll just maintain 8. So we would rather assume that currently, because it is 20 shillings and the cost is 8, we can say that is going to vary. So with that, is going to bring only a small change, not that significant. But all in all, let's look at this. The first one, so EOQ, for the first price of 20 currently, we are going to have square root of 2 times 10,000 times 100. You divide by, this is, let me have a 0.4 times 20. So now that become 8 shillings. The second one, EOQ equals to 2 times 10,000 times 100. But now the holding cost, because the price is changing to 19, we can have it as 0.4 of 19.8. So that you can see the sense of the price changing. EOQ for the third one is going to be 2 times 10,000 times 100. When you divide by 0.4 multiplied by the new price, which is 19.6. So this now will give us maybe different EOQ. Let's have the first one, that it is 2 times 10,000 times 100. We divide by the 8 shillings, which is 0.4 times 28, then square root. That should give us 500. Currently, this is 500 units. Then the next one, if the price changes a bit, let's see the EOQ. This will be 2 times 10,000 times 100. Then you will divide by 0.4 times 19.8. Then square root of it. This is giving us 503. 503 units. And the other one is going to be 2 times 10,000 times 100. You divide by 0.4 times 19.6. Then square root of it. That's giving us 505. So 505 units. So we have determined our EOQ, the expected or the optimal quantity to order. Now you want to evaluate whether this one falls within the range or above or so. So you can have this kind of analysis that we have. Let's have it as the range. The range. We have the price. We have the EOQ. We have the category. And you have the treatment. This analysis is very important for you to be knowing. You should be knowing these. So the range, the first one you're given there, let's say 0 up to, this is 0 up to 999. The second one is 1,000 up to 1999. The other one is 2,000 up to above. Now, the price, the first price is 20 shillings. This 19.8 and this 19.6. That's the price. The EOQ is 500, 503, and then 505. Now the question is, this EOQ, where does it fall? Look at the first one. The first 500, within the range, it falls within because it is between 0 and 999. So it is within. Category is within range. Within range. Higher. Then, so within range. This one, 503, it is actually not within the range. It is even below the 1000, which is below. So you can say it is below. This is below range. And same case with the third one, 505 is also below this lower limit, and therefore we say below range. Now, how do we treat when this happens? Now, if it is within the range, you have no business asking for any other quantity, like asking for less than 500, asking for more than 500. You don't have business. The economic one is a 500, so therefore you evaluate the 500. So you come and have here, evaluate 500 units. So we're going to consider 500 in our costing. Then when it is below the range, so if you are if you are to insist on 503 based on this price of 19.8, the supplier will not charge you 19.8 because 503 belongs to this range. You will be charged how much? 20 shillings. And you'll not be willing to accept that. So therefore, you will say that for me to take this advantage of 19.8, I better improve my quantity upwards up to 1,000. At least I get into this range where I'll be charged what? 19.8. So it is me to improve, or it is us to improve our quantity from 503 to 1,000. So we come and say here that evaluate 1,000. And finally, when it is below the range again, this 505, if you insist on 505 based on 19.6, the supplier will charge you where it belongs. Where it belongs here, you will be charged 20 shillings. You don't want that. You don't want 19 point. It is us, the buyers, who are going to improve our quantity upwards up to like 2,000, so that at least we get into this range, we be charged 19.6. So therefore, we are going to evaluate the 2,000. So this is evaluate 2,000. Something to note there. I am not just picking 1,000 or 2,000 because it's the one that belongs or that starts in this range. No. I am picking a quantity that belongs to this range, but also which is very close to our EOQ. I cannot take 1010, I cannot take 1050, I cannot take 1,200, 1,500 because those are within the range, yes, but they are not close to 503. So the one which is closest to the 503 and it belongs to this range is only 1,000. That's the one which is closest and will make you be charged 19.8. That's why we are taking the list one there. And that's all. Now to evaluate this, we apply the costs. So the cost will be as they appear here. We only need, but this time because the price is different, we are going to include the purchase costs. Since the price is different. Whenever the price does not change or there is no discount, you don't include the purchase price. But for this one of ours, we are going to include because the prices, you can see, they are changing. So you're going to have your TC equals to PC plus HC plus OC. This means purchase cost plus holding cost plus ordering cost. So this is going to be D times the price plus Q over 2 times the holding cost plus D over Q times the cost per order. So how are we going to substitute this? So that therefore, total cost for the first 500, we'll have it as demand is 10,000 years, but the price is going to be 20 shillings, plus holding cost is, quantity is 500, that we're evaluating here, 500, divided by 2, multiply by 8 shillings, plus demand is 10,000, divided by Q of 500, you multiply the holding cost, or no, the cost per order, which is 100 shillings. That will give us a price. The next one is 10,000 at the new price of 19.8, plus this time the quantity is 1,000, divide by 2, multiply by, we require to have some working concerning this holding cost. The new holding cost here, it is 0.4 of 19.8. So 0.4 times 19.8 is coming to 79 point. This is, sorry, 0.4 times 19.8 is coming to 7 point. So this is 7.92, which is cheaper than 8 shillings because the price is also cheaper. Then plus 10,000 divided by the 1,000 times 100. And the last one is total cost equals to 10,000 each at the new price of 19.6 plus, now this is 2,000 units ordered over 2 times the holding cost, which is 0.4 times 19.6, which is 7.84 plus 10,000 divided by 2,000 times 100. Now whichever that will record a cheaper cost, that's what is the one we're going to take. So therefore the first one will be 10,000 times 20 shillings plus 500 divided by 2 times 8 shillings plus 10,000 divided by 500 multiplied by 100. This will give us a total of 204,000. The second one is 10,000 times 19.8 plus 1,000 divided by 2 times 7.92 plus 10,000 divided by 1,000 multiplied by 100. This will give us 202,960, which is cheaper than here. And then the last one is 10,000 times 19.6 plus 2,000 divided by 2 times 7.84 plus 10,000 divided by 2,000 times 100. This is giving us 204,340, and that is now going to be the cost consideration. Now we are going to select the one that is cheaper, and you can see that 202 is cheaper than the rest. This is what you're going to take. So finally, what is going to be our optimal policy? So we can have here that therefore optimal policy as we are advising. The first advice is that the optimal, or either we can just say order size, order quantity, will be now this one, which is 1,000 units. You should go for 1,000 units. And then the next item you can say is the number of orders, which is actually the 10,000. You divide by 1,000. Remember, 10,000 is the number of units that's ordered for the whole year, divided by what we'll be ordering every time is 1,000. This means 10. So this is going to be 10 times in a year, per year. And then we can talk of inventory costs, the minimum one, which is shillings 202,960. This is what we are going to be spending, and that's what we are going to choose because it is cheaper than the rest. Otherwise, that is how we can address a case of multiple discount. Please note that you must calculate the EOQ for each and every price. As the price changes, we would expect the holding cost is changing. If we took 8 shillings to be constant, there will not be any need for us to do the EOQ for each and every price, because if this one was to be 8 shillings everywhere, then there is nothing to change. So therefore, just calculate one EOQ and then we evaluate it. But the spirit of multi-discount is where we are having the price changing and making the holding cost per unit to change. That way, we'll be having different EOQs for different prices, like I've done here. So that now we can come and check, compare, and look at the category. That if it falls within, no problem, we just evaluate that quantity that is the EOQ. But when it falls below, we evaluate the list of that range, the list, which is what we have seen here. Supposing we had an above, so above range. When something is above, let's assume that this one was like, say, 2,503. Suppose this was 2,503. we would have said that it falls above because this one is just less than a 2,000. So when it's above, it shows you that if you are to insist on that quantity, then you will buy at a price which is 19.6, which is not the price you are evaluating here. And so therefore, you would avoid this price and you go for this one. What does it mean? It means you ignore the whole of that range. It does not go well with you. You would better work with the suppliers where the 2,503 would have attracted 19.6. So that means when it's above the range, you normally ignore the whole range because the quantity attracts a better price elsewhere, unlike that one. So you ignore that, you go for that other one. So that's how we do it when it comes to category and evaluating. When you're evaluating and you're ignoring, you just do not evaluate it. But where you have put the evaluation, whether the EOQ or the lower limits of every range, then you come and substitute in the formula, in the cost formula, then get the inventory cost, then select the one that is minimum, and therefore you can have this as the optimal policy. Talking of the number of units you're going to order every time, and also talking of the number of orders per year, and as well as indicating that minimum cost that you have used to evaluate, and that is all about such a question. Now, this sample paper 2 has taken us some questions to understand concerning the EOQ or EBQ, as well as sample paper 1. Now, when we go to sample paper 3, we look at now uncertainty part of this inventory control. Otherwise, for paper 2, that one is enough, and that is good revision, and I hope you have understood and be able to follow as what we have indicated here. So for now, that is all, and may you have nice time as you make your further revision and reference. Thank you, everyone.
Hello and welcome back to the lesson. Our today's lesson is on listening to customers. Listening to customers. Now, listening to customers, candidates, is very critical in business. It can be a core competitive advantage. The ability to hear what your market is saying, okay? Understanding what they are saying. There are 3 distinct levels. In our today's lesson, we are going to study 3 aspects in relation to listening to customers. Right? One is the of active listening. Then we will analyze the challenge. Then number 3, barriers to effective listening. We are going to consider those 3 aspects of the lesson on listening to customers. First, we begin with the skill of listening. The skill of listening is more than just staying quiet while the customers are speaking. It's more than that. It is an engaged process that ensures that the customer feels seen. And in active listening, you must follow non-verbal cues. This is active listening. 1, you have verbal cues. Verbal cues. Now, verbal cues, we only talk of verbal cues when you are talking to customers physically, in physical meetings, or when the customers visit you at the shop, and so on. You need to pay attention to verbal cues. Verbal cues. You have to check their eye contact, nodding, and so on. So these are some of the things you go for. Then there is mirroring.
Mirroring. Mirroring. That means repeating the customer's key concerns to show that you are understanding what they are saying. You can, for example, say, if I understand you correctly, the main issue is that the delivery didn't arrive before your shop opened at 9 a.m. If I'm getting you right, you can repeat that to find out if you understand what the customer is saying. Mirroring, repeating the customer's key concerns, your understanding. The customer may talk for a long period of time, but you need to pick the customer's key concerns and bring them out and ask the customer if that is the main issue. Then in active listening, you need to avoid the solution trap. Avoid the solution. Avoid the solution trap. Many staff listen only to find a gap where they can interrupt with a solution. When the customer is complaining, when the customer is giving you feedback, don't interrupt the customer until they are through with what they are saying. Don't listen and wait for a moment to interrupt them with a solution. Through active listening, wait until the customer has fully vented their frustration or shared their idea. So avoid the solution trap. That is very important when it comes to active listening. Then let us discuss some of the channels for listening. Channels for listening. Channels for listening. Channels for listening. Right? Channels for listening. Yeah. This is where you listen, because where you listen is just as important as how you listen. Where you listen is just as important as how you listen. We have what we call direct or the ground. The first channel is the ground, right? This is the face-to-face feedback you get in shops, you get over the phone, you get when you visit the field, when you go to the field, when you visit the customers in the field. That information you get is what we are calling the ground, face-to-face. That is one channel for listening. Then there is social listening. Social listening. Social listening is also digital listening. That means monitoring the brand's mentions on TikTok, on Facebook groups, buyer beware groups in Kenya, and so on. On social media, you can listen to what people are saying about your brand on social media. That's another channel. Then you can listen to the data. This is silent. The data can also speak, like the M-Pesa transactions, the number of M-Pesa transactions, lies the unsubscribed rates. These are customers speaking with their actions. Data means customers speaking with their actions. They may not speak directly, but they are speaking silently by not subscribing. That is language, right? You analyze the M-Pesa patterns, the transaction patterns. That tells you a lot about your company. So these are three major channels for listening. If you want to listen to customers, go to the ground. Go to where they are, meet them face to face, make calls, receive their calls, get direct messages or feedback from the customers. Then there is social media listening, digital listening. Then we have data, can also speak. So these are three key channels for listening. And the last aspect of this lesson is on barriers. What are the barriers? What hinders listening, effective listening. Because candidates, even with the best intentions, businesses often fail to listen due to internal noise. Internal noise. You may have the best channels, you may have the best environment, but because of noise, being too focused on company targets, for example, and also company policies, can hinder you from listening to what the customer is saying. Being too focused on company targets and policies to hear customers' unique problem. When a customer is speaking, don't bother about the company policies. Get what the customer is talking about. Another barrier to effective listening to customers is defensiveness. Being defensive. Being too defensive. That means viewing a customer's feedback as an attack rather than an opportunity to improve. If you consider a customer's feedback as an attack, then you are not likely to listen to what the customer is telling you. Defensiveness. Then another cause is information overload. Information overload. Having too many feedback channels. You have feedback on email, feedback on WhatsApp, feedback on Instagram, feedback on Twitter, feedback on a website, feedback on SMSs, and so on. You have 10 phones where you've given out, customers are giving you feedback. So that can be a barrier to listening. If you have information overload, you have information all over without a central system to organize the information. Understand? Information overload. So it's important to move from listening to hearing. As you close, candidates, I need to mention it's important as you are listening to customers to move beyond just listening to hearing. Hearing implies action. If you listen to a complaint about, for example, slow website, but you don't fix the server, then the customer realizes you weren't actually listening. So that is all we can say, candidates, about listening to customers. It requires skill, the skill of active listening. You need to pay attention to verbal cues. You need to do mirroring. You avoid the solution trap. Use mirroring, avoid the solution trap. So that is the skill of active listening. And there is the channels for listening. The channels can be broadly categorized into two. We have direct channel, which is the ground when you make calls, when you talk to customers over the counter, when you visit them in the field or their shops, you can talk to them face to face. That is a direct channel. Then there is social or digital listening. Customers also talk a lot about the brand on social media platforms and so on. Then there is data. The data you have can also speak volumes. Then we have analyzed the barriers. Barriers to effective listening is internal noise, defensiveness, and also information overload. That's the end of today's lesson. Thank you for staying with us. We will meet in our next session where we'll continue sharing knowledge in marketing. Bye-bye.
Hello learner, welcome to Manifested e-learning platform. My name is Emlyn. Today we are discussing the Business and Data Analytics August 2025 question 24. The following balances were extracted from the books of Limao Limited, a medium-sized entity as at 30th June 2025. Land at cost is given, buildings at cost, accumulated depreciation, fixtures and fitting at cost, accumulated depreciation for fixtures and fitting, inventories, other operating expenses, administrative costs, selling and distribution expenses, credit loss, dividends paid, on preference shares, dividends paid on ordinary shares, tax paid, retained profits as at 1st July 2024, software license is given, bank overdraft is also provided to us there, ordinary share of 20 each fully paid, 8% preference shares of 20 each fully paid is given to us there. The share premium, 6% loan stock from EC Bank. Trade payables is provided, trade receivables, expected credit losses as at 1st October 2024. The sales figure is given, the purchases figure is also provided for us. Discount allowed, discount received is given to us there. We have some additional information. Number one, inventories as at 30th June 2025 were valued at 56 million. Depreciation, number two, and amortization are to be provided on the cost of the asset at the following rates. Asset is given as well as the rate. Buildings, 2%, fixtures and fittings, 10% per annum, software, 20% per annum. Number three, land is to be revalued upward by 5 million as at 30th June 2025. Number four, the expected credit loss as at 30th June 2025 was estimated at 2.4 million. Number five, operating expenses prepaid at the end of the year, at the year end amounted to 400,000 shillings, while unpaid administrative expenses were 700,000 shillings. Number six, the company estimates tax for the year at 9.5 million required. The audit schedules showing trial balance before adjustment, trial balance after adjustment, profit or loss items, and the statement of financial position items. And remember, guys, we are here for you. It has to balance, and we're not going to do any form of cookery here. Let's dive right in. So on the right hand side right over here, we can see this solution right here. And I'll start off by looking at, or by typing in, with your permission, I can say here TB, I can say here, or trial balance before adjustments. TB before adjustments. Adjustments. That. And of course, we're going to have a debit and credit over here. So imagine center this over here, Control B, bolden it over here like that. And I want it slightly larger than this because we want to put it the same, almost the same font as that. So that looks like 18. So that means this section over here, I want it to be 18 and beyond. So I can be able to just click right here, type, put it at 18 like that. So that it becomes much larger like that. We are able to see items at least much more clearer. Yeah. Trial balance before adjustments. And what are we talking about? We talk about the DR and the CR right over here. So you can just put the DR and the CR. That. Debit and credit. Then I center that. That. And we can see, but that of course we want the trial balance before adjustments, and we'll need to correspondingly put the values here. So I'll just perhaps try and see if this can be dragged maybe somewhere down here like that. This can also be put down over here like this, and then we can be able to then now put over here now land and buildings over here. So you can try and maybe fix this or try and move it closer over there so that now it can represent the information that is given to us over here. So you can see that here we have land at cost over here, and if you have land at cost, obviously we're saying it's just going to be, and we're going to also put the currencies like that. So we can put shillings. Copy, put this, also put it like that. It has to be boldened. So saying land and buildings over here, we just link it with this. This is a debit, that. And we move on to the next item, buildings at cost. It's an asset, so we debit also. So you're just going to drag it like that. Remember, it's before adjustments. That's what we've been told to do right over here. Audit schedules showing trial balance before adjustments, before these additional information is included, trial balance after adjustment, profit or loss items, and the statement of financial position. So that's what we have. We're doing it without any adjustment there. Next item is accumulated depreciation. We are saying on land, on buildings at 1st July 2024. Over here, we'll have it on this other side. Yeah. Fixtures and fittings at cost is an asset. So we can just perhaps just drag it like that, and then we delete this, because this is already a credit component there. This is an asset here, and this represents accumulated depreciation as an expense. Here, then we're talking about accumulated fixtures and fittings. We obviously expect it to be on this other side, right over here. So just put it like that. So just delete that. That to represent the accumulated depreciation on fixtures and fittings. So I'm just trying to make sure that at least it fits there. Then we also have the next item is inventories. It's an asset. So we have inventories. These are other expenses. Other expenses that we have over here. This is it's confirming, yes. So inventories is right over here. So we put inventories, we link it with that. That's okay. Then you're saying that because this has been accumulating, it's different from depreciation. It's not an expense per se. It's accumulated depreciation on the building, so it has to be a credit balance there. And here it also has, because it's accumulated depreciation, it has to be a credit balance. Other expenses will be debited right over here. And so we're saying we'll just debit this. Other administrative costs there will go all the way to this credit loss. This is the credit loss for the year. Dividends paid, preference shares, we're going to go. So we're going to go up until the tax paid right over here, because this represented the expense up to that point there. So maybe let me just highlight there, and that's where I'm just going to drag it until right there. And then from there, now I can just be able to perhaps just undo that. 6,500, so it's of course going to be 6,500. So we've done it up to there. And then we see this is retained profits, 29 million. Of course, 29 million is going to be a credit balance. So we just put it on this other side over here. And we move ahead right there and identify the software license. The software license is of 16,000, right? Is an asset because it's a license. So we're saying it's going to be put right over there. It's an expense. So if software license, it's an expense. So that's why we're putting it right over there. And bank overdraft, we are saying that this bank overdraft, also ordinary shares, 8% preference shares, and we're going to go all the way down here, trade payables, right over here until trade payables. But here, up to that point, we're going to now put it as, remember, we're going to put it as credit, because we're saying that from here, bank overdraft, this represents a credit. It's an overdraft, overdrawn from the account. So we just pick that value like that there until 2,800. That's what we're going to do there for now. And then thereafter, we're saying trade receivables should be a debit. It's an asset. So here, we're just going to link it with trade receivables right there. That. And then we can see that after that, trade receivables, expected credit losses at 1st of October should be credit. It's credit balance. So we put it. Let me just drag it like that. Then, but we delete this part over 1,500 like that. And then the sales will also be a credit. Sales right there. You're going to have the sales being given to us there as a credit. It is also right there. And once the sales have been given to us there, we can be able to also proceed on to see that the purchases will obviously be on this other side here. So purchases is going to be over here. So what we purchase is what we have in terms of our stock right over there. So we have 14,400 like that. 14,400. So this is 414 million. That so discount allowed. Discount allowed is what we've allowed as a discount should be debited. Yeah. And here discount received should be credited. So here we're talking about discount received being right there. So now I can be able to just come over here. Then there's nothing else. We're not going to include additional information. Remember, so this is what is going to be the moment of truth right over here. So alt equals. So I do not want it up to there. I want it to go all the way up to the top right here. That. Then I enter 723,000. And then this other side we see what it has. You can see. It's actually balanced off very well. We are not including any changes or any adjustments there. So then we can move on to identify the trial balance after adjustment. That means what? We'll need to include the adjustments. So here we come, we consider putting margin center adjustments. Adjustments like that. Of course, we're just going to copy this, the debit and the credit like that. This should be boldened, and then of course this one should be picked, of course, from here like that, and also like that. Like that. That's what we need. The adjustments, all of these should be boldened, Control B. And I'm also seeing that this should be separated. There should be a separator right over here. There should be a separator. And I'm going to put, first of all, a border like that. Let me put it a border like that, so that now we can see what is being, so this side now, I'll put a thick border now on this other side here. So you can be able to demarcate the adjustments from the trial balance before adjustments there. And what adjustments are we looking at right over there? So in terms of the adjustments, we are just going to start off by looking at the additional information right over here. So we are saying the inventories as of 30th June 2025 were valued at 56 million. So we can be able to just come and identify the closing inventory. So here I'll be able to just come over here and put in the closing inventory. So maybe with your permission, I can just drag these items down here. Allow me to do that because I want now, this of course has to be dragged, so I cut that right down here for financial position. That. So of course I'll just do away with this 20 marks over here. So that now I can be able to now then include the adjustments just side by side here. Which adjustments am I talking about? Number one, right over here. So this total, this is the total part. The total should maybe perhaps come down over there, way down here, so that I can be able to consider putting in the, the adjustments, all the adjustments. So I'm just going to create for myself some space here. Put a thick border like that, and then I'll also need to put in, first of all, that, and then a thick border, thick outside border like that. And also on this other side, I put for myself this border like that, all borders, and then like that. Now here we start with inventory. We can be able to just include the closing inventory. So inventories, this is of course statement of financial position right over here. So I just closing inventory, just come over here, closing inventory, closing inventory over here. Of course, this is financial position. That just put like that, statement of financial position, SFP, like that. And we've been told it's how much? 56 million. Oh yeah, it was valued inventories of 30th June, 56 million. So I put it right over here and say, because it's considered to be an asset, I'm not going to put it right over here. I'm going to put it right over here. Why? Because this is the debit side for the adjustments, to represent the adjustments right there. So I'll just put it center there. So right here, the debit 56. Why 56,000? Because I want it to be, I want it to be in thousands. You said you put it in terms of thousands right over here. Here we go. Then we just put the accounting format, comma, and then 2.2. Put it like that. Now that looks much better. So the closing inventory as of the profit and loss statement will come right down over here. So you can put statement of profit or loss. Statement of profit, delete profit or loss, capital or loss. Allow me to do it like that. Statement of profit or loss. Here I'm putting it as 56,000. So, but for every debit there has to be a credit. For every debit there has to be a credit there. So we drag this formula going down up till there. That's okay. So that means I drag it across like that. Those two should balance. Thereafter, we've dealt with this inventory right over here. Allow me to put a faint color there. We've dealt with that. Can we then proceed on to identify any other items? So this was what we've done. Do we have anything? So there's depreciation right there. Depreciation for buildings, fixtures, and software. So depreciation for buildings, let's copy that. Come over here. Format printer, depreciation of amortization. So I'll put over here like this. For buildings, other expense will come, how much? How much is it? Basic buildings is 2% per annum. For fixtures is 10% per annum, and for software is 20% per annum. So I can be able just to pick over here, copy. Depreciation and amortization. Control V. Not agreed. So buildings. Oh, I didn't copy it. I needed to copy this. That copy. Come over here. Buildings. Hyphen buildings. And this is going to be expense into brackets EXP, expense. How much? Buildings 2%. So you can come over here and put, if it's an expense, by here we are saying that it's because an expense, depreciation, depreciation is an expense, so it's an asset. So we come over here plus 2%, it's 2%, yes, 2% times the buildings at cost component, that 1600. Format printer, quickly write like that. And then we can be able to identify the accumulated depreciation, which is the credit now. So accumulated depreciation depreciation. And this should be perhaps just put over here like that, just beside it like that. Format printer, that. Depreciation. So this one comes, it's just there, credited. We also do depreciation for fixtures and fittings. I copy this, copy. Depreciation and amortization, right over here, I copy this, copy, come over here, that. Depreciation, and you can see fixtures and fitting is 10%. So over here, then of course I'll copy the accumulated depreciation to come down over here, that fixtures and fittings. So I come right here, the debit side. So remember, this is the demarcation right over here. So I need to perhaps slightly change it a bit here so that it is a thick border. So fixtures and fittings right here, we're saying we're picking what rate? 10% fixtures and fittings, 10% per annum. 10% times fixtures and fittings up above over here. Fixtures and fittings across 6,400. Then of course, accumulated depreciation is also going to be the same. That. We also have software. Copy software. First of all, copy this. Copy down here. Of course, I remove the fixtures and fittings. Now it's software. Copy software. This copy. That. Accumulated depreciation. Copy. Come down here. That. What rate is it? 20% per annum. Software come 20%. So 0.2, which represents 20%, times software. Which is the cost. Software license 16. You can see it's right here. 3,200. Here's the accumulated depreciation. So credited there. Now that we've done that, then we need to identify, is there any other items? So this one we've already completed right over here. And then you can see right over here, there's something that you can see, loan from EC Bank. So loan from EC Bank, 6% of it needs to be accounted for. Accounted how? We need to talk about accrued interest on loan from EC Bank as a liability, accrued interest. And then we talk about the expense itself now of interest. So we talk about accrued interest, write it down over here. Accrued interest on loan from EC Bank. This needs to be put in that EC Bank. And of course, this one, we are saying that it is a liability. Put it like that in bracket, in parentheses. And we're saying it's how? And then accrued interest, and then we talk about the expense itself. Expense. Of course, we need to indent it up to somewhere there. Somewhere there, it's okay. So what are we talking about? We're talking about 6% of 10 million. So we're saying 0.06 times 10,000, which is of course 10 million. We're saying that represents 600 liability. But the corresponding credit is going to be expensed. 600. It still balances off there. Now let's look at any other item that we have in land. Is to be revalued upward by 5 million as of 30th June 2025. So we talk about land revaluation. Totaling to what? 5,000 or 5 million. Land, excuse me, revaluation. So we're saying if it's going to be revalued upwards, it's a gain. Land revaluation gain. We've been told that because it's been told land is to be revalued upwards, that's a revaluation gain. So revaluation gain is debited, it's a gain. And then we credit which account? Revaluation reserve account. Because it's a revaluation gain. So revaluation gain, and you're saying it's just going to be 5,000. That represents 5 million. Then revaluation reserve. is going to be credited. That. Evaluation gain, I didn't include what is gaining, land, first rate land there, and revaluation reserve should be indented like that. Revaluation reserve, 5,000. That. So land completed, put it like that. Now we now move on. You can see the next item that we're looking at right here. Expected credit loss 30th June 2025 is estimated to be 2.4 million. So what happens then? The credit loss we're seeing is 5 million, and from the expected credit loss right here, credit loss is 400. You can see here we have 400. You can see we have 400 here. What is that? This is credit loss for the period, but we're looking for expected. Yes, this is it. The expected credit loss as at 1st October was 1.8 million. But what are we told down here? We are told that the expected credit loss as at 30th June 2025 was estimated to be 2.4. So if it is 2.4, then what happens? We expect the difference between 2,400 or 2.4 million and this expected credit loss as at 1st October right over here. That should be what is called the gain on expected credit loss, or increase in expected credit loss, which is considered to be an expense. So increase in expected credit loss right over here by 600. Increase in expected credit loss, increase in expected credit loss, EXP, expense, right over here. Also put a capital E right over here. And you're saying the increase is how much? We've just taken the difference between 2,400, which is down over here. You can see the expected credit loss was 2.4, and the difference between that value, that figure, and this one here, getting 600 right over here. So 2,400 minus 1,800 like that, we're getting 600. And where is the corresponding credit going? The expected the corresponding credit is going to go to become an allowance. Yeah. So transfer to allowance. Let's say transfer to allowance. Transfer to allowance like that. Here, transfer to allowance, just pick that value like that. Let's try and identify if there's any other item that is already completed. Of course, those two are completed like that. We can see there's operating expenses. Operating expenses prepaid at the end of the year amounted to 400,000, while unpaid administrative expenses were 700,000 there. So we just talk about operating expenses prepaid. Let's come over here, copy that, put it right here. Operating expenses prepaid. Now this one will go to SFP, statement of financial position, that. And how much is the figure? We told 400,000. SFP is an asset, 400. And then we're saying that this, the corresponding credit will go to the statement of profit or loss. SFP. So you can put statement of profit or L. Statement of profit or L like that. Allow me to use that. Statement of profit or loss. Come here. Put figure there. So we've completed this. Unpaid administrative expenses. So unpaid administrative expenses, I can come here. Copy. In terms, we can say administrative. Hello Lana, welcome to Equity Investment Analysis, Lesson 3. I'm your instructor, Emlyn James Ngwiri. And in this lesson, we will look at 3 questions as follows. November 2016, question 3B. May 2016, question 1D. And September 2015, question 4C. So let's start off by looking at November 2016, question 3B. The question reads as follows. The following information relates to Pepino Limited, a global food retailer specializing in hypermarkets and supermarkets. The current market price per share, 56.94. The dividend growth rate, 8.18%. The risk-free rate, 5.34%. Equity risk premium, 5.32%. Equity beta, 0.83. Current dividend per share, 0.575. The earnings per share is 1.837. Required, the justified trailing and leading price earnings ratio based on the Gordon growth model. Number 2, based on the justified trailing PE and the actual PE ratio computed in B1 above, determine whether the firm is fairly valued, overvalued, or undervalued. So we try and identify the inputs to that question. So we're looking at November 2016, question 3B. So since we have been given a list of inputs where we have the current market price, the dividend growth rate, the risk-free rate, equity risk premium, we need to first of all identify what is the question asking. The question is asking the justified trailing and leading price earnings ratio based on the Gordon growth model. So justified leading P/E. The formula justified, put it like that, P/E is given as follows. Justified leading, apologies, justified leading PE. P/E is given as follows. 1 minus B over R minus G, where we have 1 minus B being the dividend payout ratio, dividend payout ratio. R is required return, and G is the growth rate. That. So we slot in the inputs and try and identify, do we have the dividend payout ratio, do we have the required return, and do we have the growth rate? So based on the question, I can see we've been given the dividend growth rate. We have the component of G, yes. We have the risk-free rate, we have the equity risk premium, and the equity beta. Those inputs will be able to help us get the component of required return. We're saying the required return is given by the CAPM formula, capital asset pricing model formula. And do we have the 1 minus B? We don't have the 1 minus B, but we have the dividend per share given to us and the earnings per share given to us. This is the dividend payout ratio. How else can we be able to express the dividend payout ratio? DPS divided by the earnings per share, or the EPS. So, have a working over here. We say to calculate the dividend payout ratio, which we're saying is 1 minus B, can also be computed by getting the DPS over EPS. The dividend per share, DPS, dividend per share, that EPS, earnings per share, like that. So we have the dividend per share given to us. So the DPS over EPS is as follows. We've been given the 0.575 divided by how much? We've got the earnings per share of 1.837, and how much is the dividend payout ratio? Very quickly, calculator, 0.575 divided by 1.837. How much? 0.313. 0.313. This is what we're saying is the dividend payout ratio. That. And this dividend payout ratio, so we're saying, is 0.313, which is equals to the same as 1 minus B. We've already explained what 1 minus B is over here, the dividend payout ratio. So we are saying 0.313 is the component of the dividend payout ratio, which is that numerator there. Trying to get the required return, we move over on this other side. We have the inputs of the required return. So R is the same as CAPM, so which is capital asset pricing model. So we are saying R is equals to RF plus RM minus RF beta, where RF risk-free rate, RM return on the market, beta is systematic risk, the component of non-diversifiable risk. So we plug in the inputs. So R is given as RF plus RM minus RF beta. So RM minus RF is the equity risk premium. This equity risk premium is what we have been given in the question. So we say R is giving us RF. Have we been given the risk-free rate? Yes, I can see 5.34%. So 0.0534 plus the equity risk premium. We've been given 5.32%, 0.0532. And then now you multiply that by the beta component. The beta to us is given as 0.83. 0.83. So how much do we have as our R? We use our computer, a calculator rather, not a computer. So you're saying it's 0.0534. Then we add, open the brackets, 0.0532 multiplied by 0.83. Close the bracket. So we have this 0.0975, or we're saying we have 9.75% given to us like that. Now, we've not completed. We need to go ahead and compute the justified leading PE. Just continue on this other side here. So now we have the 1 minus B given to us, which is the dividend payout ratio. So we have 0.313 there. We divide by the required return. The required return, we've just computed it as 9.75%. So we can convert it to decimal, 0.0975 minus the growth rate. As per the question, the growth rate given to us is 8.18%. So it's 0.0818 like that. So how much is the justified leading PE? How much is the justified leading PE? So it's 0.313 divided by 0.0975 minus 0.0818. Close the bracket. 19.94. 19.94 times that. Once we have the justified leading PE, we need to get, still answering part 1, we need to get the trailing PE ratio based on the Gordon growth model. So the trailing P/E ratio is given as 1 minus B 1 plus G over R minus G. We've already defined what the inputs are. We've defined what 1 minus B is, we've defined what required return is, and we've defined also what G is. So we don't need to also explain further the inputs. So we slot in the values given to us. We have 1 minus B as 0.313. Then we multiply that, multiplied by 1 plus G, 1 plus the growth rate. The growth rate given to us is 8.18%. So we are saying it's 0.818 like that. So I'll probably now move on the other side over there where we have the required return. We've already given us required return as 9.75%, 0.0975 minus 0.0818, 0.0818. So moving on to this other side over here. Moving on to this side, we just need to solve using the calculator. So we have 0.313 multiplied by 1.818. I think there's a problem there. It's not 1.818. This should be, because it's 8.18%. Please correct this. This is 0.0818. So correct that, please. Kindly apologies for the error. It's 0.0818. That. So let's correct that. So we have 0.313. Then we multiply by, open the brackets, 1.0818, close the brackets like that. Then we divide that by, put the bracket, 0.0975 minus 0.0818, close the brackets. How much do we get? 21.56 times. 21.56 times is what we get as the justified trailing PE. Now, to answer part 2 of the question, we've been asked, based on the justified trailing PE ratio and the actual PE ratio computed in P1 above, determine whether the firm is fairly valued, overvalued, or undervalued. So we need to get the current PE. And which value are you using? Of the two, justified and leading PE, we have been told to use the justified trailing PE value. So this is what you're saying. So we need to get the current P/E or price earnings ratio. Current PE ratio is given as what? So P/E is given as market price divided by earnings. That. So which you're saying is market price. Have you been given? Yes, 56.94. We divide that by the earnings per share, which is 1.837. 1.837. How much is our PE ratio? We have 56.94 divided by 1.837. We have 30.99. 0.99. There. It's a pretty high PE ratio times. There. So the guiding formula is like so. If we have the current market price being greater than the intrinsic value is the value that you as the analyst have computed, or you as the learner have computed, then we are saying that that is overvalued. So we are saying if we have the current, rather you can say if the current market price is greater than intrinsic, to brackets I can put it, if the current market price is greater than I, then overvalued. Done. If the current market price is equal to the intrinsic, comma, open the bracket, CMP is less, or rather is equal to I, then we say it is correctly valued. Put it like that. If the current market price is less than intrinsic, saying CMP is less than I, then it is undervalued. In this case, hence, we are saying what is our position? We are using this 21.56 versus this one over here. So this is the current PE. This one seems to be greater than this one, and this is the scenario over here. So this scenario is saying that the share seems to be overvalued. Hence, we are saying in this case, Pepino Limited is overvalued. Overvalued, like that. So we are saying, into brackets, we can put 30.99 times is greater than the 21.56, which is that scenario there. That concludes November 2016, question 3B. Now we'll move on to now May 2016, question 1D. It reads as follows. Joshua Chitema, an equity and investment analyst for an investment bank, is reviewing BTP Limited, a small cap firm whose shares trade thinly on the over-the-counter OTC market. He compiles the data presented below and estimates the forward-looking equity risk premium using the Gordon growth model. To the risk premium computed, he adds 1.5% to account for the additional small firm risk premium associated with BTP Limited. The following data is provided relating to the Gordon growth model. The current price level of the market index, 1,480. The current year's dividend on the market index is 31.25. The year ahead forecasted dividend on the market index is 33.6. The long-term earnings growth rate for the market index is 6%. The current long-term government bond yield is 4%. The current short-term government bond yield is 2.75%. Joshua shows his computations to the chief investment officer, who suggests that the macroeconomic model with supply-side analysis using Ibbotson chain model provides a better estimate for BTP Limited's risk premium. The CIO suggests that BTP Limited commands 0.75% risk premium for its thin trading, in addition to the small firm risk premium that Joshua has already considered. The relevant data is presented below. The expected growth rate in real earnings per share, EPS, is 3%. The expected growth rate in price earnings ratio is 1.5%. Expected income component is 2.5%. Expected treasury inflation protected securities TIPS yield is 2.15%. Expected inflation 1.81% required. The risk premium for BTP Limited's share using the Gordon growth model. Number 2, the risk premium for BTP Limited's share using the macroeconomic model factoring in the relevant adjustments. Looking at May 2016, I can wrap this as well. So, May 2016 question 1D. So the model that is used to compute the risk premium based on the Gordon growth model is given as follows. So risk premium, so you can put over here RP. So RP is equals to the dividend yield plus consensus long-term earnings growth, right? Then we less the current long-term government bond yield, current long-term government bond yield. So all of these inputs have been provided for us. So we just try and identify the dividend yield. The dividend yield is given as dividend over price plus, I can put it in short, earnings growth, like that, plus long-term government bond yield. So bond yield, like that, which is given as the dividends on the market index. You've been given as 31.25. You divide that by the price. What is the price of the index? You've been given as 1480. That. Then we add the earnings growth rate. What is the earnings growth rate? We've been given the long-term earnings growth rate on the market index as 6%. So you can put in decimals, 0.06 plus the bond yield. What is the bond yield? I think there's a bit of a mistake here. We're not supposed to add the bond yield. We're supposed to less, isn't it? We said less over there. So it's supposed to be lessing. Apologies for that. Less the bond yield. The bond yield given to us is 4%, yes. We're given 0.04. So how much is the equity risk premium? Very quickly, let's pick up the calculator. Saying is 31.25 divided by 1480. Like that. So we have 0.02 plus 0.06 minus 0.04. We are saying we have 0.02 plus 0.06 minus 0.04. We have 0.041. 0.041, or we are saying we have 4.1%. That is the equity risk premium based on the Gordon growth model. Now, part 2, the question is asking what? Part 2 of the question is asking the risk premium for BTP Limited's share using macroeconomic model factoring in the relevant adjustments. And by the way, if you look at what Joshua Chitema has actually said, he actually proposes that we need to add a 1.5%. So on top of this, before we go to part 2, on top of this 4.1%, so we are saying the 4.1%, he adds an additional 1.5% to account for the additional small farm risk premium associated with BTP Limited. Apologies, that was something very key that he needs to add. So you need to add 1.5%. So how much is it? We are getting 5.6%. That is what we're saying he needs to do. So that is the equity risk premium based on the Gordon growth model. Part 2. The macroeconomic factor model formula is given as 1 plus I, I'll explain that, multiply by 1 plus EPS, multiply by 1 plus PE, minus 1. Then you add income, then you less Y, which is the yield. So where, so this is macroeconomic model. Probably could you put over here macroeconomic model. This is the one that is used to estimate the equity risk premium. So it's more holistic. I is inflation rate. EPS, earnings per share. Then we have PE, price to earnings ratio. Then we have the income component, which I was saying is the income, which is pretty given to us directly. And then what else have we been given? We've been given the Y. Y represents the risk-free rate. So Y is the same as risk-free rate given to us. Plugging in all of the inputs, what do we have as the risk premium? Saying we have how much using macroeconomic model. So we are saying we need to look at the inputs, identify the inputs. What is the inflation rate given to us? The inflation is 1.81%. So it's 1 plus 0.0181. Yeah, that's 1.81%. Multiplied by 1 plus what is the EPS? The EPS given to us there is 3%, 0.03. Then what is the PE ratio? You've been given as 1.5%. 1 plus 0.015, 1.5%, like that, and then minus 1 there. Then we add the income component. The income component given to us there is 2.5% plus 2.5%. Can we just wrap that and rewrite it down on this other side? So plus 2.5%, then we less now the risk-free rate. In this case, the risk-free rate given to us there is 4%, 0.04. That, or to be holistic, we are saying we need to say plus 4 minus 4%. So we are saying we have what? Multiply these inputs, then we minus 1, and like that, how much are we getting? So this is expressed in percentage. So for consistency purposes, I think it's only fair to be consistent. We just need to put this into decimals like that. So if you allow me, I can put 0.025 minus 0.04. 0.025 minus 0.04. Just being systematic. So what do we have now? Let's see. 1.0181 times 1.03 times 1.015 equals, we get 1.064. So I'll just be holistic. 1.064 minus 1 plus 0.025 minus 0.04. So this component is given by that component there. So I will move over on the other side to get the complete value. total value, the total value. Total value. How much? So minus 1, then plus 0.025 minus 0.04. 0.04937. I have 0.04937. Or we are saying we have 4.937%. That is what you're saying is the risk premium using the macroeconomic model forecasts. That concludes our question in May 2016, question 1D. Now we will finalize this session, or this lesson rather, by looking at September 2015, question 4C. It reads as follows. Robotics Limited's shares are currently selling for 24 shillings and have paid a dividend of 1 shilling per share in the most recent year. The following additional information is given. The risk-free rate is 4%. The shares have an estimated beta of 1.2. The equity risk premium is estimated at 5%. Required. The constant dividend growth rate that would be required to justify the market price of 24. So, we need to identify the inputs. So we are saying we'll be looking at September 2015, question 4C. 4C. So the dividend growth rate, so they're looking for the dividend growth rate. Now we know very well the value of the share is given as D naught, DO, 1 plus G over R minus G, where we're saying V naught, value of share, D naught is dividends, then G is growth rate in dividends, and then R is required return. Now we haven't been given the required return. You will note we haven't been given the required return in the inputs, but we've been given the value of the share as being 24. We've also been given the dividends. The dividends is 1 shilling. And then we've also been given, we've also been given the growth rate. The growth rate is how much? The growth rate in this case is what we are looking for in our question. So we have that, and we need to calculate this based on the inputs given to us. We've already been given the risk-free rate as 4%. The shares have been estimated beta of 1.2 and the equity risk premium of 5%. We can be able to use the CAPM formula so that we can be able to get the component of the required return. Yes. So the CAPM formula, to wrap this, so you're not doing May 2016, so CAPM. So R is equals to RF plus RM minus RF beta, where R required return, RF risk-free rate, RM return on the market, then beta is beta, which is systematic risk. So R is equals to RF plus RM minus RF beta. We slot in the values. What is our RF? We've been given RF as 4% plus. This is the component of equity risk premium. RM minus RF is equity risk premium. And we've been given the risk premium as 5%. 5%, you multiply that by beta. Beta is 1.2. So how much is our required return? So saying it's 5 times 1.2, we get 6 plus 4, which you're saying is 10%. So R is 10%. Now, based on the formula on the other side of how to get the value of a share, we go ahead and plug in the inputs in the formula directly because we have all of the inputs now. We have all of the inputs. So now we have V naught is given as D naught 1 plus G over R minus G. So V naught, we're saying we've already been given that as 24 shillings. So 24 is equals to the D naught we're saying is 1 into 1 plus G. G is what we're looking for over R minus G. R we've computed over here as 10%, which you're saying is 0.1 minus G. G is what is the unknown there. So cross multiplication. So we have 24 times 0.1 minus 24G, because you're cross multiplying that, is equals to 1 plus G. When you open 1 times 1 is 1. 1 times G is G. There like that. Solving for G. We take this G on the other side and we take the 1 on this other side. So we have 24 times 0.1 minus 1, because 1 is positive, it comes on this side, becomes minus 1, is equals to 24G, becomes positive, plus G. So here we have 25G, like that. Yeah. So what is 24 times 0.1? So it looks like 2.4. 24 times 0.1, we have 2.4, yes. So it's 2.4 minus 1. So 2.4 minus 1 is 1.4 is equals to 25G. So you divide by 25, you divide by 25. How much is our G? G is equals to 1.4. 1.4 divided by 25. 0.056. 0.056. Or we are saying it is 5.6%. That is our growth rate, and we have answered the question, the dividend growth rate. This concludes our lesson for today. Thank you for having me, and we hope to see you in our next lesson.
Hello and welcome back to the Marketing and Communication class. Today we are going to discuss the importance of customer service in a business. Previously, we defined customer service as the support and assistance that is provided to customers before, during, and after a purchase. It is typically reactive. That means it happens when a customer has a specific question or problem. So what is the importance of customer service? And candidates, in a competitive environment where competition is fierce and where word of mouth travels faster than WhatsApp status, customer service is the ultimate differentiator. It's not just about solving problems. No, customer service is a strategic investment that directly impacts the company's bottom line or the profitability of a company. So, why is customer service the heart of any business? The first reason is in relation to the financials. Customer service has financial impact on revenues and profit. The first reason is financial impact. Customer service has a financial impact on profitability. Exceptional service isn't just being nice to have. It is not just to say that company A is nice to its customers. No, it's a profit driver. Research has shown that businesses prioritizing better service can grow revenues 4 to 8% above their market. And also, roughly about 60 or 70% of customers are willing to pay more for a brand known for great service. And that is why people return to the same seller every time. You find people returning to the same mama mboga or to the same kinyozi or to the same mechanic, even if a cheaper one opens nearby. When they do that, they are paying for the peace of mind they get when they buy that service or product. You understand? Yes, so there is a financial impact. It directly impacts the financials. It financially impacts the bottom line. The second reason for having customer service, the importance of customer service is that of cost effective. Okay, cost effective. Proper customer service, excellent customer service. In our last session, we discussed about excellent customer service, ways to excellently serve your customer. Why should you do that? It is cost effective because of retention versus acquisition. The cost of retaining an existing customer is cheaper than the cost of acquiring a new one. Acquiring a new customer may cost 5 to 25 times more than keeping an existing one. You understand? Yes. So it's cost effective. The third reason is in relation to competitive advantage. Competitive. It gives you a competitive advantage or edge. Competitive edge. In many industries like retail, like salons, like hardware stores, products and services are almost identical. If you go to a shop, the sugar that competitor A sells is the same one you are selling, because this retail, you are selling products for the same producers. You may find that traders are selling the same product. There is no difference. So customer service then becomes the only differentiator. If you are in an industry and you are all competitors are selling, all suppliers are selling the same product, the only thing that differentiates the businesses is not the product, because the products are the same. The only thing that differentiates is just customer service. Customer service is often the only way to stand out when you are dealing with products that are the same in the market. If two shops sell the same, say, gas cylinders at the same price, the one that delivers with a smile delivers with a smile and a thank you. A smile and a thank you SMS will win the neighborhood. But the one you go to is just frowning, like the way my producer here is frowning, always frowning, okay, not smiling. People will not come to buy your product. So the way you serve becomes the only differentiator. And even the smaller companies can use personalized service to beat large corporations that often feel robotic or out of touch. Understand? Yes. Can give you a competitive edge, especially when you are selling the same products in the market. We are discussing the importance of customer service. Number 4, brand reputation and social proof. Brand reputation and social proof. That's another reason. Brand reputation and social proof. Brand reputation and social proof. Now, in the age of social media, one bad interaction can reach thousands of potential customers in an instant. Just one bad interaction. One bad interaction with one customer. That one customer can cause you to lose your brand reputation instantly. There's what we call multiplier effect. A satisfied customer, on the other hand, might tell 3 people. But an angry customer, especially on TikTok or on the Facebook group, will tell 3,000 people. So positive service turns customers into brand ambassadors. It can go either way. The way you treat your customers, that will be amplified. If you treat customers well, your business will grow. If you treat them badly, it will have a negative impact on your reputation. Understand? So when employees, we are talking about customers, brand reputation, and social proof. That's another reason why customer service is important. Treat customers well, and they will be your brand ambassadors. That is the 4th reason why customer service is important. Number 5 is in relation to employees. Employee morale. Employee morale increases the morale of the employees. Employee morale and also retention. There is a direct link between happy customers and happy staff. Happy customers, there is a correlation between happy customers, a positive one, and happy employees. When employees are trained and are empowered to provide great service, they feel pride in their work. They feel more proud of their work. When they are trained and they are empowered to offer great service, they are motivated to do so, which again affects their dealing with the customers. And staff are less likely to quit if they spend their day having positive interactions than fighting with frustrated customers or clients. In other words, if you don't train your employees well, and in our previous sessions we showed you how to develop a program on training. If employees are not well trained, they will not be able to serve customers well. Okay? They will meet frustrated customers who will frustrate them more. Because employees should be trained to deal with the difficult customers. So when employees on day-to-day, they meet difficult customers who spoil their day, they spoil their mood, they are likely to quit the job because the job is hectic. They are not able to handle the difficult customers because they are not well trained. But if you train them on how to handle these employees, then they are motivated. They are not frustrated. That's why we said there is a correlation. There is a direct link between the happy employees and the happy staff. So train your staff, they be happy, they treat the employees well. They treat the customers well. But if the employees are not well trained, they may mistreat even the customers because they don't know how to handle difficult situations. So these are 5 reasons why customer service is important. Number 1, it has direct impact on financials. It is cost effective, can give you a competitive edge. It positively impacts brand reputation. It also leads to increase of employee morale. These are 5 reasons why customer service is important. Thank you for attending the lesson. Bye-bye.
Like this. We put it somewhere, I don't know, excuse me, not like that. For adjustments, of course, this is just going to be copied from here. Like that, we center these. We also get these values from here. So that now we just now put accounting for, of course, the borders, and then we put now the thick outside border there. Not before, it's after it here, after adjustments. That. Now, after the adjustments, then we can be able to just adjust. And here we can be able to see that we're just going to spool the values from here. After adjustments, what we're going to do, we'll pick this value here, landed cost, and there was a figure that we had adjusted right down over here. Can you see this figure right here? This figure right over here was land revaluation gain of land over here, and you can be able to see it's debited over here also. So anything to do with land, in any other item that deals with an expense, including operating expenses, we will be able to spool them and link them with these. Like in this case, we're going to add that value right over there, and we add what? And we add this 20 million, because this is landed cost over here. So that's what we have, landed cost. The next item right over here is buildings at cost. There's nothing that was touching on buildings, so we'll just link it with that value like that, nothing else. As far as accumulated depreciation on buildings, please, we come over here and we know that it's on this other side, so we will pick this 5,000 over here, and then we add what is down over here. We'll need to see what is on this other side over here. Buildings. Yes, you can see this is it. Now this is where is the buildings? Okay, the buildings. Yes, here you can see. Here we have accumulated depreciation on buildings, because it's credited, so we are adding that credit component there. We are adding that one. We're not adding this one, because this is going to be an expense. We're going to expense it. When we create a statement of profit or loss, we're going to expense this one as a debit. But in this case, we're putting it right there like that. Now here, there is no change on this item over here. Which item is this? This item relates to the, push it just right over here so that now everything can be on one screen. Over here like that. Yeah, that's better. That. So here we have 64,000. This item is fixtures and fittings at cost, but we expect something to change as far as accumulated depreciation on fixtures and fittings. It's credit, so we'll pick right over here. I'll just pick the credit right over here, and then I add the fixtures and fittings depreciation component here. So depreciation of fixtures and fitting, accumulated depreciation, you can see it's right here, 6,400 like that. So this is what I have now. Here we have inventories. There's really nothing much that is touching on inventories. So there's nothing attached on inventories. We just put it right here. Inventories, that 42,000. And then of course, we're just going line by line. Other operating expenses, we're saying that we need to make adjustments. Why? Because this item over here, or this figure, other operating expenses, we need to subtract one of the items that was actually paid down over here. Which item am I talking about? I'm talking about the operating expenses prepaid. Why? Because we're seeing that here we have other operating expenses, and from the and from the adjustments here, or from the asset here, we see operating expenses prepaid over here amounted to 400,000 over here, prepaid. So they were actually prepaid. So we need to subtract that component here from the other operating expenses figure, which is over here. So I subtract it because we've actually credited it right over here, the 400 here. Operating expenses prepaid. Let's move ahead and analyze administrative costs. Administrative costs, we're talking about, there was something that was given, administrative costs right over here. And you can be able to see from the additional information, operating expenses we've adjusted, unpaid administrative expenses, 700,000 there. That was the 400, and that and administrative expenses 700,000. So what do we need to do? We will need, because it is unpaid, we will need to consider adjusting these 5,600 right over here, 5,600 over here, and we add, because it is unpaid, we add unpaid administrative expenses right here. It's administrative expenses right over here. We add this. It's statement of profit or loss. Enter. We are moving on well, right over here with no problem. We also analyze selling and distribution expenses. Anything that was touching that, there was really nothing that was touching that, so just put it there. That. How about the next item you can see right here is credit loss. Credit loss is nothing that was touching that. There's difference between credit loss and expected credit loss. So that one does not have anything that is affecting it. We also don't have anything that is affecting dividends and preference shares and ordinary shares. We don't have those ones being affected by anything. So I just sort of drag them like that. And then we can move ahead and consider tax paid, trial balance after tax, after adjustments. We don't have anything affecting that. That tax paid component, please note, this tax paid component will be fixed, or will be, the figure will be used when we create the statement of profit or loss on this other side over here, right on our right hand side here. So this one we leave it. And for now, the retained profits, no adjustment. Retained profits here. It's right here. Retained profits is on this side. 29. And then software license. Nothing affecting the software license is right here. 16,000. That. We also don't have any changes on these bank overdraft. We don't have changes on this. So come here. This is on this side. Come there. 500. That. So we don't have changes on these items. I'm just looking on my right hand side over here. Preference shares. There's nothing. There's no also change on share premium. We also don't have changes on the next item, 6% loan stock for now, but we'll expect some changes. The adjustments will be able to be adjusted or be placed just as the way we've indicated over here. We're going to talk about expense, and we're going to put a statement if it's at expense, if it's statement of financial position, like that, SFP, and so on and so forth. We're going to be able to effect those changes there. Then, so here we don't have any changes. These two, this is trade payables. We don't have any changes on that. Do we have changes on receivables? Receivables now is on this other side, so we come over here. We don't have changes on that. Do we have changes on this item, expected credit loss of 1,800? We have a change on that. And what is the change on that? We will be able to just pick the 1,800 because we're saying it's expected. There's a difference between the credit loss and expected credit loss. So we are saying that here we will pick this value here, and then we add the expected credit loss adjustment, which is right over here. We are saying the expected credit loss as of 30th June was estimated to be 2.4. So the difference between the 2.4 million and this 1800 right over here, which you're seeing is the 600. The 600 is what we need to add. We need to add that one because it's an increase in expected credit loss. So we'll add which value? So increase expected credit loss expense, we'll increase it with that. 2400 we have there. So what about the sales figure? It's nothing that is adjusting that. The sales figure. How about the purchases? There's nothing that was touching on the purchases as well. So just put it like that. Yeah. Here, do we have discount allowed? The discount allowed, don't see any adjustment to do with the discount allowed after this one here. We are having discount allowed. Don't have that, neither do we have any changes on discount received. Don't have that. And this one here, discount received is 13. There. But we're saying that we'll need to have changes on the accrued interest, this expense component here. We'll need to include it. And we're saying that we're going to include it right over here. Right there. Now the corresponding debit or the corresponding credit debit on that value there, or the expected credit loss. This was the expected accrued interest on loan, sorry, not credit loss. So this is accrued interest. So the accrued interest, as you can see here, accrued interest, I'm just trying to, so this was the accrued interest. So what about these others over here? Depreciation in buildings, those ones we've already considered them. So here we're talking about this one here. We're talking about, this was it debited. This was the liability component here of 600. So the liability, expected credit loss, this was the liability, or it was the liability from the expected credit loss. So then it must be this liability component here. Excuse me, guys. So this liability here, if it's a liability, then it should have been on that side, and this one here should have been on this other side here, like that. So that now it will still balance because we are saying that this is an expense. Remember, it's an expense. I even indicated here it's an expense, so it should be on this side right over here. And so here, the liability should be, yeah, so this one should not be that. This should be the liability. This should be the liability, and the corresponding liability should be accompanied by the credit should be accompanied by the debit component there. So each of these items should be accompanied by a debit. So here we already accompanied those two right there. Now we're talking about inventory, closing inventory here. You can see that here we have 56,000, which was debited. So we'll also just need to put them the way that is that, and this one is that one there, that. We also need to do the same for this depreciation here, expense right over here. So it should be that one there, and then this one should be that value there, that. As far as So we also do the same for this. This is depreciation of fixtures and fittings. We also do the same for that. So for this item, software, that value there like that. You can see I've already done for liability, for the accrued interest on liability, and the expense component should have been debited like that. So that's okay. How about this land and revaluation? So it's the same. We should be able to consider doing it for revaluation. So for revaluation reserve, so we're talking about revaluation of land. And when revaluing land, so we're talking about, this is land and this is revaluation reserve. So the revaluation reserve is the one that should be SFP. So revaluation reserve, this should be credit. This is what should be there, 5,000. So this should have been accompanied by revaluation. Do we add 5,000 somewhere? This is land, is valued upward by 5 million, so 5 million. So land, you can see the value of land went up by from 20 to 25. So that 5,000, which represents the debit, has been accompanied by the corresponding credit right over here. That's what we're saying. And for the expected credit loss, which is here, increase in expected credit loss, remember transfer to allowance, this is as an expense. So we'll need to consider this value here like that. But the credit loss, this 600, the corresponding 600 credit right over here, should not have been over here, has been considered in the expected credit loss. The credit loss was at first, yes, this one here. You see here, I have added this component plus the 600. It should be, because it's credit, so it should have been this other, so it should be that one over there like that. So that now it can be represented because it's credit. It's debit, credit here. So this credit has already been considered there. So I'm not going to consider looking at it there. So how about operating expenses? Prepaid. This one should be considered right over here. So prepaid, this was prepaid operating expenses. So we go back to operating expenses. Operating expenses, other operating expenses here, you can see it's actually gone down by 400 from 13 million to, so the debit has been accounted for, but the credit right over here should be considered. The credit, this should be, not be that, because this is also on the credit side, so this should be that value there. Remember. Now, how about, we need to ensure that it is going to be controlled. How about the administrative expenses accrued? Administrative expenses accrued, the 700 that is, we will just need to consider just this credit right here. Why? Because this other 700 we are considered in the administrative expenses. Where? Administrative expenses, administrative costs here. You can see here. This was the debit. You can see the debit. And it is increased by 400. So the corresponding credit, was it 400 or 700? Yeah, it's 700. Because it's administrative cost. 5,600 plus 700 over here. It comes to 63. Then here, the 700 now credit component comes over here. How about this tax expense? 9,500. The 9,500, we are saying needs to also be looked at. Tax expense. So this is the SFP. And we need to exclude the tax paid. What am I saying? I'm saying that this was 700, it was, this was, you can see here, this is debit. This is debited. So this 700 should be on this other side. Over here, excuse me for that. So it should be that debit over here. Excuse me for that, so delete that. Because you can see this debit, credit, debit, credit, debit, credit, like that. And I'm not going to go against this because it's already balanced. You can see it's balanced here. So if it's debit, it should have been debited here. So here we're saying that I expect to have this statement of profit or loss component as being 9,500, which we're saying is a tax expense right here. Tax is 9.5 million, and we subtract the tax paid. How much is the tax paid? Let's look at the tax paid right over here. Tax paid is 6,500. You can see 6,500 right over here. So if I subtract the 6,500, I get 3,000. We proceed on to put the corresponding debit. The debit is this one here. This one is going to go to statement of financial position, the 9,500. Now these are the totals. Let's perhaps drag them slightly down here in case there are any other changes that we need. All borders. We need to come up over here like this. Put it like that, thick border. Thick border. And here we need to now demarcate and separate them. That thick border. And over here, this other thick border here. That. So here, we can be able to check and see if indeed our trial balance is going to be balancing. If it doesn't balance, then there might be something wrong. We need to check. So it's not balancing. And we just go back up over here and see which items have not been considered. So starting off, we start from down. The tax debit has to be, so this tax debit, this is the statement of profit or loss. So I'm saying that I need to ensure that I need to have this tax debit. The tax debit is this one, statement of profit or loss. Or the statement of financial position, this should be this should be this. This should be that. Enter. And then we're saying that this is the one that should reduce. How should it reduce? So we pick that and we subtract the tax paid. Tax paid was how much? You can see the tax paid was 6,500 here, this one. So we have that. So that's where the error was. And then we'll need to also identify any other changes, because we're looking at statement of financial position after the changes here. So after adjustments. So this and after the adjustments, so this and this is what I'm looking at, these two, because that's a demarcation there. That's okay. This is okay. This is okay because we're saying it's 700. Let me see. This is a debit. So that 700 debit, was it catered for? 700 debit, which is this is administrative expenses accrued. Administrative expenses accrued. Let me see. Administrative costs. Oh, it was catered for over here. You see, I've debited right over here. I have debited because I've included that plus the 700, because this is the debit on that side, then I've added the 700 over here like that. So that one has already been included like that. So this 700 should not be over here because I've factored that one in this calculation right over here where there is the formula there. So here I just remove this 700 from over here. How about the credit? Was the credit considered? So delete this one. How about the credit? This is the one that goes to the statement of financial position, so it may not have been included. So let me include it over here, 700. That. So that 700 has been included. Let me see this 400. What is this? This is the statement of profit or loss. Profit or loss, the 400. Right over here. Was it included? What is this? This is operating expenses. Operating expenses. Other operating expenses. This is debit. And over here it's 12,600. So this should be, the debit has already factored in the debits, the debit component. So because it's picked that debit and I've subtracted it should be this debit. Why am I subtracting? Because I'm saying that operating expenses prepaid at the year end amounted to 400,000. But now this credit, so it has already subtracted that. You can even see it has already subtracted, yes, it has already subtracted that credit. That. Because it's a debit and I subtract that 400. What about the corresponding debit? Remember, this is a debit right here. I'm talking about the administrative expenses here. So administrative expenses, you can see here it is. So what I've done, is it administrative expenses really that I'm looking at? No, I'm supposed to be looking at, yeah, administrative expenses 700. So 700, so here 700 has been included here, 700. So it has been added. So we pick the debit and I add this debit here, yes. So the 700 has already been included there. Where is the corresponding credit? Is the corresponding credit here. That's okay. Now I'm looking at this other one here. Operating expenses. Operating expenses is 13 over here. So this is the debit. Operating expenses. I've subtracted the credit to represent that it's reducing it, but this credit should not be on this side because I've already excluded it. This credit should actually be a debit on this other side right over here like that. So this one should actually be removed. That. So once I have the 400 there, I confirm if we have this increase in credit loss, expected credit loss, that is okay. So we'll look at this, this one is okay. It's okay, there's a valuation reserve. Then we have 3,200. So this is that one there. So what about this 5,000 revaluation gain on land? This one will come to be adjusted later on. So the 3,200, yes. This 600, I can see the 600 here. This 600 represents an expense and this liability. So we're saying that we expect the expected credit loss expense should be considered. The expense. Expected credit loss is a debit. Consider debit on this side. Debit, credit. So here we expect a debit. Over here, what about the accrued interest loan? Sorry, not expected credit loss. This is okay. The accrued interest on loan, this 600 should be a liability, so it should not be there. So that should not be there. 600. Because I'm talking about expected credit loss. No, not expected credit loss. I'm talking about the accrued interest on loan. accrued interest on loan. So accrued interest from loan is okay. It shouldn't be a problem because that is okay. It's not balancing by how much. So the difference is that we subtract that value, 8,000. So that would be easier for us to identify. So this expected credit loss, accrued interest from loans, so I've confirmed that should be there. So this one, the 3,200 is okay. 64 is 64. Let me see. Accumulated depreciation shouldn't have a debit and a credit like that. It shouldn't be like this. Clearly you can see it's only a debit component that is there. So we remove this credit that is right here. This one will go to accumulated depreciation in the statement of financial position. So delete that. That should not be there. I'm only remaining with 1,600. So this 1,600 should be our guide. So here we're talking, so one is an expense and one accumulated depreciation should be financial statement of financial position. So this should also be removed. That. And you can see this is actually balanced right there. Now it becomes easy for us now to construct the trial balance, the statement of profit or loss. So we come up here and say profit or loss. Profit or loss. Or loss. So we just put these two margin center close to each other like that. Okay. Margin center, then drag it like that. Put the profit or loss. Margin center like that. Of course, I'm just going to copy that and that. That. Here, of course, we'll just put the figures, put the borders, and we also put thick border outside that, bolden. So we start with the profit and loss items here. Moving towards our right over here, we cannot see any item that is that is for profit or loss. Allow me to just slightly squeeze it over here like this, so that it can remain on one screen here. This is what you're working with. So this figure shouldn't be so much of a problem for us to work. So here you can see the first item for profit and loss that we're going to be working with is, we can see inventories right here, and you can see the inventory is 42, so it's a debit. I'm going to pick that. We're going to be working this one here because after adjustments, not this side over here. So here we're going to drag all of these values going down because you can be able to see that all of these represent expenses. So here we're going to drag it until right over there. That's okay. But maybe perhaps require to put the totals up over here. So these ones are going to be boldened. Control B. That. And once I've done that, now we move on this other side and identify any other item. Oh, I can be able to see right here that we have retained profits. Now retained profits, no, that is going to be used in in the statement of financial position, so that's not a problem. So I'm just going to look for sales. Yes, sales is here. So we put a credit, that. And obviously the sales, then of course the next one is going to be the purchases right there, that. It's obviously not going to balance as of yet now. Then we will now consider the discount. Now this discount over here, just going down there, put it like that. This is discount received. Yes, we'll put that value there. That. And then we put any value that we need to put. We need to put this accrued interest on loan. This is an expense, so we need to put it as a debit here. That we need to put that. We also need to put this. This is expense. An expense. This 1600. Yes, put 1600 there. Yeah, this is depreciation and amortization buildings. 1600. I've put that already there. So I need then to put what is this? Closing inventories. Statement of profit or loss. You can see profit or loss. We even put it right over here, so that needs to also be put there like that. And then we go 1600 like that. So we are going now. Let's go line by line over here. Accumulated depreciation. So buildings, we've already put that 1600 there. This other item for 6400 over here, we say depreciation of fixtures and fittings over here. We need to put it also as an expense. So we put that as an expense there. And then we can be able to see right over here, depreciation of software, 3200. We need to put that as an expense there, like that. And you see it's debit, not credit. Debit over here. And that, so we proceed on right over here. This is credit, accumulated depreciation, no. This 600, we've already put the 600 right over there. And then this is revaluation reserve. This is an expense. The 5,000 here. Revaluation reserve. Revaluation reserve is an expense, so we'll need to put it as the credit component. So this revaluation reserve, you can see it's credit on this side. So we need revaluation reserve, credit. There. So this is debit. So you put a debit over here, and this credit should also be there. Should it really be there? Because I'm just looking at 3200 represents software depreciation and amortization. Then accumulated depreciation. Accumulated depreciation, no. So the 5,000. Maybe revaluation reserve, no, should not be there. I may be identifying figures that may not be the ones that are there but are supposed to be used. So let me just double check and see if indeed we're okay. The 3200, yes. 32 is there. The reason is okay. The 600. That. The difference, I should try and see the difference over here. That is what is going to help me. 33,400. So I will need then to also identify this is statement. This is statement of SPNL. So this is 9,000. So I'll need to put 9,500. Let me start from down now, because this is debit. I'm going to put it right over there. That's okay. So it keeps on reducing. Then we also identify so that's 9,500. This one is 600. 3,200 software. Then there's 6,400. So I'm checking first for the credits, the debits. Then I see 6,400. Yeah, that's okay. You get the 1600 is expenses, that's an expense. Then I talk about the 5,000, which is okay. This 14, yes, is okay. 6,000, and these ones are okay. So here, have I considered all of the values here? No, it's this other side now. Debit. Yeah, that one is okay. This is okay. Expense. 13. 480 sales is okay. Sales is okay. So I'm not sure of this 23,900. So this is debit. That should be debit. That's okay. This credit should be SFP. Okay. This is okay because that's okay. One more time, just one more time. 3,200. It's okay. That's okay. It's an expense. 6,400. 400. 1,600 is okay. So I'm looking for, oh, there's another 600 here that I didn't include. This one here. Increase in credit loss expense. This one here. Yes, guys, this is what this 600 right over here. So what you can say, I think I've confirmed it. Not I think, I am sure. As manifested publishers, I can confidently say that I'm okay here. And what we can say right over here is the balancing figure. Balancing figure. Balancing figure right over here. So that is, this 23,300 should be the balancing figure, and I'll put it right over here. So here I can be able to put it in a different color over here as the balancing figure. 23,300. That, so it's not summing up all of it up to there. Enter. So that, now the only way we can be able to identify if we are not cooking, we never cook here at Manifested Publishers, that's unacceptable, is to see if indeed these figures are going to balance the statement of financial position. So what I'll do is that I'll just go to the SFP with your permission, and then identify those, the corresponding items for SFP. SFP items. I'm over here, SFP items. SFP items. SFP items. SFP items. That should be the same format painter. That. So just copy that item like that. And of course I put the borders as usual. The borders and a thick border, like outside border. Control B. Up to there. So which means that I will need then, of course, that's just formatting. So this item now allow me to hide this. I can hide those ones there like that. Hide. But if I hide that, the adjustments will not be able to, after adjustments, yeah, that's okay. So I hide. The adjustments we need, because that's what we need for. So I'll unhide once, because I needed to see what these figures are right over here. You can see that this is of course land. But here you're saying you're going to pick this after adjustments. That's what you're going to pick. And the corresponding value right over here is buildings at cost is also going to be picked. Then we pick this accumulated depreciation. We adjusted that. Done. Well, that was not adjusted. It wasn't adjusted. We adjusted it. Accumulated depreciation. Yes, we adjusted that. And then we come over here and pick this fixtures and fittings at cost. We pick that. Fixtures and fittings. And then we also pick this is credit because it's credited right over here. You can see here. Thereafter, because these ones have been debited, you can see they've been debited, they've been replaced by profit and loss items over here. I've replaced with that. So I'll come over here and put the 29,000 right over here because it's credit. You're saying retained profits right over here. These ones have been copied right over here on the statement. What appears on the profit and loss should not appear on the statement of financial position. So here, you're saying I'm just going to link it with that 29,000 like that. And then here, I link it also with this because this represents the software license. Asset, debit. Then here, what is this? This is 2,500. So I'll link this. This overdraft, ordinary shares capital, up till here is okay. I can just drag it. It has not appeared in the statement of financial position. You can be able to see it right over here. It's not appeared. And here, trade receivables. I'll just pick the trade receivables as is. That, and then expected credit loss. I pick the expected credit loss which has been adjusted here. 400. This is the sales. It doesn't appear. Purchases does not appear. It should not appear at all. And then we come down over here and identify any other item right over here. Just trying to identify these items here. This land revaluation. Revaluation of land, we are saying should, or accrued interest rather. Let's look at first of all accrued interest. Let's go systematically. Accrued interest. Increase expected credit loss. Accrued interest, yes, this 600 right over here. Remember, it appeared right over here, and you're seeing this is a liability. So if it's a liability, then we're seeing the liability should appear as a credit right over here. As a credit. So this is debit credit. This is the statement of financial position. You can see here. But now it should appear as a liability. Liability. The 600 should appear as a liability. Here 600 wasn't there, and then we proceed on to identify another item here which you're saying is closing inventory 56,000 right here. 56,000 closing inventory. Any other item? I don't see any other item. This 3,200 right over here. This one appeared in the statement of financial position right over here. There's a debit. So the credit here, accumulated depreciation 3,200 should also appear here. Credit 3,200. What else? This evaluation reserve. But yeah, as a credit, debit credit. So as a credit should appear here. Now, do we have any other item that is not considered? This 5,000, this 600 was considered over here. This 400 SFP, the SFP 400 needs to appear. It did not appear over here, but it needs to appear right over here as a debit. It did not appear in the statement of profit or loss. 400. We put it right there. How about this 700? Did it appear? This 700 is administrative expenses accrued. 700, this credit needs to be put as a credit right here. That. 3,000, which you're saying is tax expense, needs to be put as a credit. It's not here. The statement of financial, so it needs to be considered. There. So here, this tax that needs to be included. The 9,500 needs to be, this is administrative expenses accrued, the 700 is okay. Tax expense needs to be considered. Which figure? The 3,000. Yes, tax expense needs to be considered, yes, as an expense. And then, so the totals here, I need to get the totals so that I can be able to identify. Yeah, 274,400. So what if we put this over here? Does it perhaps change? Let's check. Because the totals are coming up to there. So we put 23,300 over here. 23,300. And look at that. Actually balances. Like I said before, that here at Manifested Publishers, we don't just do guesswork. We ensure that it balances off over here. And we are here for you any day. So now the rest is just remaining is just for us to be able to present it in a proper professional format. That, and then now with your permission, I can be able to just undo this iron hide. And here, if we can just move it like this, is our completed solution right over here. So all we are told to do the trial balance before adjustments. We make the adjustment, we made the adjustment, trial balance after adjustments, the profit or loss has already been done, SFP items, and we identified this balancing figure as the one that is going to be right over here like that. Thank you for being with Manifested Publishers. Bye-bye.
Greetings, candidates, and welcome to the lesson. The subject is governance and compliance audit. Today we are starting on a new topic known as gathering audit evidence. This topic has 16 subtopics. Number 1, nature and sources of audit. 2, types of audit evidence. 3, evidence gathering. 4, data collection instruments. 5, document checklists. 6, literature review. 7, questionnaire, survey, or confidential discussions with select members of the board and senior management. Number 8 is site visits. 9, limitations in gathering audit evidence. 10, types of audit tests. 11, audit sampling. 12, using the work of experts. 13, using reports of board evaluation and other internal governance assessments. 14, methods and techniques of auditing high risk areas. Number 15, data analysis. Number 16, evaluating of evidence and forming conclusions. That is the last subtopic, evaluating of evidence and forming conclusions. Now, candidates, in governance and compliance audit, gathering sufficient and appropriate evidence is fundamental to forming an objective opinion or conclusion about an organization's adherence to its governance framework, laws and regulations, and internal policies before the auditor forms an opinion as to whether the company is complying with laws and regulations and so on. The auditor is required to gather sufficient, appropriate audit evidence. That's why we are saying this gathering of evidence is fundamental to forming an objective opinion. You cannot form an opinion without evidence, and you cannot get evidence before gathering. So you have to gather audit evidence. Then on the basis of the audit evidence, then the auditor comes up with a conclusion or an opinion about an organization's adherence to its governance framework, laws and regulations, and internal policies. Because that's the objective of a governance and compliance audit, is to form an opinion. And therefore, it's important for us to study the subtopics that I have just read to you. beginning with the nature and sources of audit evidence. So let's begin with the nature. In this lesson, we are going to cover the first subtopic, which is nature and sources of audit. So let's begin with the nature. What is the nature of audit evidence? Now, first of all, candidates, audit evidence refers to the information that is used by the auditors in arriving at the conclusions on arriving on conclusions or making an opinion. You understand? Audit evidence is the information that is used by the auditor in arriving at the conclusions on which the auditor's opinion is based. It encompasses both information that supports and corroborates management's assertions and any information that contradicts them. So the nature of audit evidence for governance and compliance audit can be categorized by studying, first of all, the form. What is the form of this evidence and characteristics? To understand the nature of audit evidence, we study the form and characteristics. The form and the characteristics. So let's first study the form. What is the form of this audit evidence? Number one, audit evidence can be in form of documents. We are studying the form. It can be in form of documents, documentary evidence. Most common type, this is a most common type, which includes policies, procedures, contracts, minutes of the board. We have licenses, permits, emails, reports, logs, certifications, training records, organizational charts. All that will comprise documentary evidence. Audit evidence can be in form of documents. Then there is oral documents or evidence. Oral evidence. Oral means word of mouth. This is information that is obtained through inquiries and interviews with the management and employees, with the legal counsel, with other relevant parties. Oral evidence. The auditor may have a discussion or an interview with the board of directors. Oral. Okay? He asks questions and they answer. Oral evidence. Or we may call it testimonial. Oral evidence or testimonial. From the word testimony. Testimonial. Oral evidence. So audit evidence can be in form of testimonies. 3, you have visual evidence. Visual means the auditor may observe, may make observations. Okay? For example, observing security protocols, observing physical access controls, observing workflow processes, and so on. 4, electronic, digital evidence. This is data that is stored in databases, in system logs. Data may also be stored in email archives. Data may be stored in security alerts, system configurations, and so on. Electronic evidence. Number 5, we have what we call analytical evidence. Analytical Analytical evidence, on the other hand, candidates, is information that is derived from comparisons of data or trends and ratios. For example, comparing incident rates over time or analyzing compliance training completion rates and so on. Ratios, analytical evidence. So this is a form of audit evidence. It can take this form. Documents, form of documents, testimonies, visual evidence, digital evidence, analytical evidence. Then let's study the characteristics. Remember, candidates, I've said to understand the nature of audit evidence, we study the form of audit evidence and the characteristics of audit evidence. These are qualities of good evidence. Number one is sufficiency. Sufficiency. That means the quantity of audit evidence. Is there enough evidence to support the auditor's conclusion? We are talking about quantity. And this is a matter of professional judgment that is influenced by the assessed risk of non-compliance and the materiality of the area being audited. Number two, appropriateness. Appropriateness refers to the quality of audit evidence, encompassing both its relevance and reliability. Relevance and reliability. Relevance is the evidence relevant. To know whether evidence is appropriate, you check its relevance and reliability. Relevance and reliability. That's the second characteristic of audit evidence, appropriate of good audit evidence. Relevance answers the questions like, does the evidence logically relate to the audit objective? If you are auditing, for example, you want to find out if the company is complying with statutes or laws. You want to find out, you are auditing, you want to find out the company is complying, obeying the laws and regulations. So the appropriate or the relevant information there would be the law. So if you are to check if the company is complying with the statutes, then the relevant evidence would be the statute. You don't check internal policies, for example. That would be relevant. You understand? Yes. For example, a training log is relevant evidence for testing compliance with training requirements. You check the training log to find out if the company is adhering to training requirements. So the training logs becomes the relevant audit evidence. Then there is reliability. That is to answer the question, can the auditor trust the evidence? And reliability is influenced by the source of the evidence. Evidence from an independent external source is generally more reliable than from internal evidence. We are discussing the characteristics or qualities of good evidence. So the first one is sufficiency, then we have appropriateness. Are you following, candidates? Yes. And these are the key characteristics. Now, to elaborate more on reliability and appropriateness candidates, I've said evidence from independent external sources generally more reliable than from internal sources. We can also say documentary evidence is usually more reliable than oral evidence. Written evidence is more reliable than oral evidence. And original documents are more reliable than photocopies. We can give another example. Evidence obtained from systems with strong internal controls is more reliable than evidence obtained from systems that are weak. Next, we have evidence obtained directly by the auditor through observation, through reperformance. Evidence that is gathered directly by the auditor is more reliable than evidence that is obtained indirectly. Furthermore, evidence may also be relevant in terms of timeliness. Okay? Evidence that relates to the current period is more reliable than the one that relates to prior periods. Understand? Yes. So, can the auditor trust the evidence? So, reliability is influenced by the source of evidence. Reliability. Let me put it down. It's a very important point. Reliability. I've said, let me come to page 2, is influenced by the reliability of evidence is influenced by, number 1, the source. What is the source of the evidence? Number 2, the nature of the evidence. Is it written? Is it oral? Internal controls, I mentioned the internal controls. Evidence obtained from a strong internal control system is more reliable than evidence obtained from weak internal control system. There is number 4, directness. Directness. Evidence obtained directly by the auditor is more reliable than evidence that is obtained indirectly, for example, from the third parties. So that is all candidates for the nature of evidence. Let's move to the next part of this lesson, sources. Sources. Sources of audit. Sources of audit evidence. Sources of audit evidence. Now, auditors gather information from a variety of internal and external sources within and also related to the audit organization. So we have evidence from internal sources. We can categorize this evidence. So one source is evidence obtained from management and personnel. The auditors can gather evidence from the management and the personnel, the workers. And that can be done through inquiries and interviews. Inquiries can be gathered through inquiries and interviews. These are techniques that may be used. Discussions with the leadership, for example, with the CEO, with the board, with the audit committee, with compliance officers, with the legal counsel, with the HR department, with the IT department, departmental heads, frontline employees to understand policies, processes, and also roles and responsibilities. Inquiries and interviews. Number 2, written representations. Written representations. These are formal letters from management confirming certain facts or assertions. For example, assertion that all known non-compliance incidents have been disclosed. So that is